Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
The delta of paper is equal to the partial derivative of rock with respect to rock, paper, scissors. If you think like a trader, we've got your back. Tasty Trade. Join the club, genius.
Wonderful time of the year. That's because stocks are up again. It's Monday, December 23rd, 2024. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan in Milan. For the final episode where the Three Musketeers are here, I'll be out the rest of the month into the new year. Dylan and Ilya also taking off some time for the holidays. So sporadic schedule here the rest of this week. Overtime will be here on Thursday, Monday next week, Thursday next week as well, and then back to regular programming once we get our way into January. But until then, let's talk markets, guys. Welcome. If you're on the platform, come over to YouTube. Tell us what you're trading. If you're on YouTube, come over to the platform or tastylive.com and see what we're all about. Guys, it was a rocky day, so to speak. Ilya, you and I on Futures Power Hour spent a good deal of time talking about the big risks on the macro level for 2025. So we really didn't focus on today's price action. But I can tell you that from when I looked at the markets last night, when the NASDAQ was up 0.5% to when it was down about 0.5% this morning, to now back where we are today, up by 0.78%, there was some good two-way volatility here as we start this holiday shortened week.
Indeed. We are seeing sort of what we talked about in the wake of the Fed last week, the idea that we hit important levels of support across a lot of markets in that sell-off, and that there was likely to be a pull-up off those levels because there was really no reason to panic and run around with your hair on fire. That, of course, the adjustment has to be respected, but that no critical levels were taken out. And although the trend, for example, in the S&P here, where you see the uptrend from August has rolled over, where you have some serious technical damage done, you nevertheless probably don't have the impetus for a stampede out in the waning days of the year. And so you'd have a pull-up, which is precisely what we're looking at. A pull-up that gives you the correction, but doesn't overturn the breakdown. That line in the sand around 6,100 that marks the break, that's holding. This looks corrective for now, but obviously the range in which this could be corrective is big and wide and could be very, very traumatic for those of us that are bearishly inclined to try to front run. Thankfully, I'm short off the top there. And so I'm just sitting here waiting, letting this move work its way out. And once it finds where ultimately it will grind to a stop, eyeing an opportunity to lay in a little bit.
I mean, Chris, how far does it have to go? How far does it have to go until these non-believers start to quiet their souls and just give up? I mean, you would think they would have already stopped thinking anything.
I actually disagree. I think it's completely opposite. I think what would get Ilya on board with being a bull would be like a full year of the S&P moving sideways. That way, earnings catch up. And we can see, and the economy can catch up.
Okay. So is that oil? Is that this SMH chart? You get some good sideways charts.
Well, like if S&P was at 7,000 tomorrow and we woke up, right? I think Ilya would be way more bearish than he was today.
Oh, 100%.
I
would be so bearish. I would be indignant.
So I don't think there's a number. It's like a question of how, it's not just the destination, it's the journey, the pace and velocity. And so I think people are looking at this market as we covered. I encourage everyone today to go back and look at the archive for the Futures Power episode for Monday, December 23rd. It's going to be running during that typical 1 p.m. Eastern slot for the next week while I'm out. Ilya and I covered the risk for 2025, and we have a discussion around valuations. We cover a bunch of these various issues, Dylan. But, if we're going to a place where the market is heading into next year with sentiment at all-time highs, effectively forward earnings estimates at all-time highs, then you probably have a market that, if we continue to push higher, the bearish folks are actually going to get more incentivized to get short because they're going to think it's even further out of whack and there will be an even bigger correction. So I don't think capitulation's here yet. And that's one of the reasons why some of these charts that I look at, like SMH up 3.14% today, and it's still grinding sideways, but getting to the apex of a potential consolidation. If this begins to break out, semis have not been a participant. And they would be a real kick in the pants for this market to get another gear to another new level of all-time highs. So this, to me, can't be ignored. At least for the next week and a half. Because the Santa Claus rally window opens up on Friday. Friday being one of the final 3 days of the trading year, Friday, Monday, Tuesday. And then the first two of the new one, S&P has averaged a gain of 1.3% since 1950 during that window. In some years recently, it hasn't worked. But again, that's why we look at the long-term average. Nonetheless, we're heading out this final week with markets starting to move up. Ilya, I wanted to talk about the trade ideas that you were mentioning, though. Get away from my perma bullishness. And we don't even go into the charts that I was sending you and Victor and one of our former coworkers over the weekend at like 3 o'clock in the morning to talk about why it was prudent to stay bullish. But I want to talk to you about the other ones.
I was actually up and reading them.
You were, and you were responding. And last night I saw a text message from you at like 3:45. I'm like, this son of a bitch doesn't know what time it is. He's like, he should know that I'm not sleeping. It's like, well, I'm actually not asleep, so how could I be mad that he's texting me? That's really. But you mentioned two things.
We're degenerates, folks. We're degenerates.
I'm one of those people who only sleeps like 4 or 5 hours a night. My wife will debate that with me, but I really don't need to get a lot of sleep. You talk about positioning here. These are charts that I shared with you over the weekend that caught my attention. I tweeted them out. If you didn't see me tweet them out, it means you're not following me. Follow me at CVecchioFX. Daily sentiment index, a gauge of how people are positioning, how people feel in terms of. Well, we'll talk about the dollar index here. Right now, it's sitting up at a level that is in the 3rd percentile. We're talking about TLT, where the daily sentiment index is now in the 10th percentile. In fact, it was even lower than that when the reading came. What we're getting at here is that the market is at an extreme place. Everyone is basically bullish the dollar to a level unforeseen in years. Everyone is bearish TLT, at least the way that the market has moved in recent weeks. TLT has seen a shift that's bearish enough, that unseen since, late 2023 when the bottom was in. Ilya, you mentioned your high conviction trades. Dylan, you agreed with him about the euro. A long euro trade is effectively a short DXY trade. It's effectively a bet on TLT going up because it means that yields are going down.
That's right.
Ilya, are these charts of the positioning and the sentiment that we're facing in the rates and currencies markets indicative of how you feel that equities may behave until the end of the year? And so I guess wind that back, break it down for us. What are you doing with this information on the screen? Mm-hmm. How does it impact your trading ideas? Does it reinforce what you said to Tom at the end of last call? And then talk about equities.
No, it absolutely reinforces it. I think we are in what is essentially bizarro September when it comes to the Fed rates dollar story. In September, the markets wanted the Fed to be really dovish. The Fed came out and was indeed very dovish. The response from markets, you're too dovish. You're giving us too much of what we wanted. And so what's going to happen is you're going to reflate the economy. And so we've had a massive rise in the dollar, massive rise in yields, massive sell-off in bonds. Against that backdrop, we, of course, had U.S. economic data getting firmer, which is why the markets reacted the way they did. Now, in December, we've had the polar opposite situation. The markets after 2.5, 3 months, thinking the U.S. economy is soaring, the Fed is off sides, they need to be more hawkish. The Fed, again, gave them what they wanted, almost to the basis point. And the markets went, oh, now you are way too hawkish. Because guess what? U.S. economic data is now going the other way. It started to cool. The PCE numbers last week were a little bit cooler. The consumer confidence numbers we just saw, unexpectedly soft. This is starting to happen the other way. So it looks like bonds are overcooked on the downside. They probably have room to bounce as markets unwind some of their hawkish repositioning. The dollar has room to weaken. That means things like the euro, the pound, look like they're shaping up bottoms and might bounce. What this interestingly means for stocks is on a day like today, you have a perfect example where you have yields rising, stocks rebounding. I actually think we might be in a situation going forward where yields coming in, bonds coming up, and the dollar weakening isn't a good story for stocks because it's a story about global deceleration. We talked earlier when we spoke about the idea that the U.S. economy is the only game in town. Of the three major global economies that power growth for real, you have the U.S., China, and the Eurozone. Of them, China hasn't grown in a year and a half. The Eurozone is back into contraction mode. Their rebound from recession in the first half has failed. The U.S. is the only one growing. If the U.S. slows, as the data might be starting to show from about mid-November or so, as it cools, you have a problem. And valuations
do you have a problem,
are,
or do you have a stronger euro? Do you have a benefit to?
No, you have a better euro. You have a weaker dollar probably across most vectors, but what you have is an equity valuations issue because if the U.S. slows, there's no plan B. And that is a bad scenario for risk sentiment in a year when a lot of debt rolls over, in a year when all of these other global economies need for the Fed to be easier, not tighter, because they need global credit cost looser, not tighter, because they're not growing like the U.S. is or anything remotely close to it. So we have an issue developing. So I think, yes, bonds higher. Yes, dollar weaker. But that might be a story about equities coming down this time. Just picture today's price action in reverse.
The dollar story is definitely worth watching into next year. We've shared the, I think it was from Steve Dunsey, the Pictet Asset Management in Japan chart with the dollar index analogy for what happened after the 2016 election going into 2017, where the dollar peaks in January 2017 once the drums of trade war begin to beat a little bit louder. And contextualizing that analogy then, given what we've heard out of the Trump administration saying things like there's going to be tariffs on the EU unless they buy more of our gas, or that we're going to annex Greenland, buy it from Denmark, or we're going to take back the Panama Canal, right? There is a very heavy trade war story behind all of this right now, right? The Panama Canal is about trade first and foremost, but this is really about control of the global trade system. And so I look at a dollar index here with that analogy and the sentiment index, and it makes me think that we could be looking for a bit more weakness in the DXY at the start of the year. And also then, if we think about what happens historically speaking, this is a great chart from Jake Bernstein. We see here 10-year Treasury yield after the DSI falls to 10. Well, we just had this happen here at the end of last week on Thursday. Historically speaking, a month later, yields are lower, about by 0.24%. We see a month later, 1.81%, 2.5%, 3 months later, 4.66%, and 5.79%. As you move out in time, directionally, it gets a stronger push for yields to move to the downside. So this could be the exhaustive move in the short term. And I think that's what Tom is getting at, Ilya. If all of a sudden the dollar's getting weaker and yields are coming off the board, that decline in U.S. manufacturing production that we see through the PMIs, we're in contraction territory, maybe that picks up a little bit because U.S. made goods look a little bit cheaper in relative terms. And we're the place that's growing after all, so why not buy from America? Dylan, one thing that happened at the end of last week as well, as we look at the end of this year, is how breadth improved in the market. This comes from Sentiment Trader. We saw that we had the worst breadth day in 3 months on Thursday, followed by the best one. And when you have that happen, when you go from the worst breadth day in 90 days to the best one in 3 days, what occurs thereafter? That's the 20th time in history that you've seen that flip in breadth occur to such a degree. A week later, the market's higher 70% of the time. A month later, higher 80% of the time. 3 months later, higher 85% of the time. A year later, higher 85% of the time. Kind of feels like last week may have been a seminal turning point where we did our chop and grind and reshuffling of the deck through the middle of December through the Fed meeting. And in the short term, the risk may be cleared. So why not super glide?
And I think it just also speaks to, I think, to your point about Ilya, and just about more broadly than anybody's point of view about a sideways market, insofar as any bought time without meaningful price level changes, time that allows earnings, revenue, cash flow systems, logistics, customer service, all things that actually businesses are, to get better without changing the price. So if you can stay, like to your point, if you can stay sideways for a year, then you get a lot of repair work that happens inside balance sheets and customer service and supply chain.
Yeah, I mean, absolutely. If you can hold up over the course of the next year, it need not be a correction in price. It could be a correction in time, whereby things digest. It need not be an aggressive sell-off. The balance.
Is that where we are with oil? How about an oil short, just on the Trump oil boom?
I was going to do the Don Draper, like, hear me out. What if there's no correction and we just keep rallying?
Yeah.
That's how I'm going into next year, right? I'm riding. I'm not going to be actively trading the next few weeks. I was joking with people, like, should I take this time off? Should I not? My wife's got to work. So, okay, my daughter's going to be home from school. Do we get a sitter? And I work. It's like, what if I have a day where I'm trading and I lose a lot of money? So I just spent a few $100 on someone to watch my kid for the day while I sat at home and lost money. I would be a very grumpy dad. So just going to take the time off, no trading. What am I content with holding into next year when I really start checking my book again on January 6th? Well, on the follow page, got to stay long NASDAQ, got to stay long ES, got to stay long Russell. Not going to swat the hand that's been feeding me all year long, Dylan. So
I'm going to keep my short too. For now.
Okay, well, Dylan, I'm trying to be like the ghost of Christmas
How about
past.
we get consensus on a Tesla short? Is there any Tesla?
Yeah, we got a Dennis Gartman trade out there before. For those who don't know Dennis Gartman,
we're never going to agree on the stock market.
Oh no.
When I first started working, his letters were very popular on the street.
Yes.
And he would offer really interesting trades, like short Japanese rice in euro terms. And you'd be like, what the hell are you talking about, Dennis Gartman? But I was hearing something from Dylan before. You were kind of pitching a short Tesla in euro terms. Why do you feel like the first?
I was saying long euro currency versus the dollar, short Tesla. I'm not saying short Tesla in euros.
Well, if you're doing both of those trades at the same time, you're effectively.
That's what you end up with, essentially.
That's what you're ending up with, right? Tesla's a dollar-based currency. And
this was really what Dennis Gartman was talking about.
Right.
Where he'd be like, long wheat in gold terms. You're like, okay, so you just want to gold trade.
So you're saying you want me to short Tesla in like Milan or Frankfurt in the Euro ADR?
Maybe. But so why do you feel like the first buddy trade is something that even needs to be discussed right now?
Well, no, this big. It's only because Sosnoff likes to talk about price extremes. And Tesla is the best extreme that exists since the election. And so it just gives us the most opportunity for a clear possible repricing.
Is there anything that's happened in recent days that make you feel that way? Like Donald Trump saying that Elon Musk can never be president?
Not just the biochemistry of two highly unstable billionaire psychopaths in the same car.
Fair point. Ilya, is the Tesla trade coming undone?
I think you have to be really careful here. Obviously, I'm highly skeptical of the first buddy presence as an idea and as a lasting thesis as well. I think anybody should, because when you look at valuing a company, you have to look at and say, okay, well, what is this nebulous thing that Elon Musk's proximity to Trump going to achieve for Tesla specifically? And yes, his presence will achieve something maybe, but what? What exactly could the administration do unilaterally for Tesla only, specifically? Very difficult to imagine.
What about large government contracts?
Yes, there's a report out this weekend that Palantir, Anduril, OpenAI, SpaceX may be putting together a consortium to jointly bid for government contracts moving forward.
But that's not unilaterally at the hands of the president and the president only.
No, it's at the hands of Congress, which are funded by Peter Thiel, who has significant sway with the Palantir and Anduril folks. So it kind of feels like...
I think the Sosnoff's biggest point this year actually just came last week in a Truth or Skepticism, which is the only asset that's at risk is the integrity of the markets, for the very reason where Chris is sort of wandering now, which is that, if there's too obvious a layer of corruption to the point where you're wrong, Ilya, or because the president does just assign huge contracts to Musk consortium companies or not, that risking the integrity of the American contract and financial markets is the number one risk that the Trump presidency represents. Whether that's a massive or small risk is a matter of debate. But
idea. Go ahead.
No, I made my point.
I mean, the idea that the markets can live with these contracts going to these companies is, I think, a reasonable one, because, of course, these companies are the best at what they do. Palantir is the best at what it does. Tesla is the best at what it does. SpaceX is the best at what it does. These are deserving companies. There's no question there. The question is, does the move make sense outside of all of those things? And if the entire logic here is Musk proximity to Trump to some sort of unspecified win outside of the norm, outside of those companies.
Let me ask you this, Ilya. Let me ask you this, good sir. Let's assume that there's the coming First Buddy breakup.
Sure.
Do you think
I think is coming?
Okay. So do you think that reduces either the dollar value or odds of confirmed win for the Musk-Leighton Defense Consortium in the government contracting process?
I think it depends.
Think it's irrelevant?
I think it depends. I don't think it's particularly relevant because I think since these companies are the leaders in their fields, I think they will get those looks anyway.
This is where you and I diverge, because these people, this is a vindictive. This is not.
Well, and so this is my next point: is if the breakup is a bad one, I think you're right. I think the president has shown a vindictiveness to his enemies, and if Musk suddenly becomes an enemy, which I think is unlikely, I think he'll just kind of move out of the
Cauchy's saying it's
sphere.
50-50. Cauchy's saying it's 50-50 in a year.
Yeah. So I mean, Doge doesn't have any power anyway. It just has the power to write a report and have some ideas in it.
Only showing that the primary asset is social proximity of Musk.
That's exactly right.
President.
That's exactly right. And so I look at the move in Tesla and I say, which part of this outsized move is the proximity versus the contracts that would probably go to these companies anyway because they're leaders in their field?
90%.
Which is the outsized
90% proximity.
Okay. Last week,
as a move in the price, as opposed to the realized reality of contracts.
The majority of the price move since the election.
Exactly. I agree. And so I look at that and I get skeptical.
Okay.
But you don't want to short with us. That's what I don't understand.
I don't want to short because it is a move built around hopium and wishful thinking as opposed to solid foundation.
It's based on the certainty of the psychological matrix of psychopaths' inability to sustain intimate.
That kind of move can go on for a long
contact.
time, though, because it's untethered from anything economical and real. So that can happen for a very long time and can be very painful. Would I short Tesla individually then? No. NASDAQ? Yes, absolutely, just not yet. And a company like Tesla, were it to get cheap enough, I'd be a buyer.
What about the Musk contract on Cauchy, 50-50, that he's even involved in 12 months?
I don't put much stock in that.
I'll tell you what, like I go back and forth. Last week I was on The Price of Truth with Victor saying I think that Trump is disrespecting Elon by giving him Doge. And then I see the events that happened in the following days with the government shutdown. And Musk liked the final plan, and Trump was not a fan of it because it didn't include a debt limit extension, which understandably so, right? Why would Democrats give that up? That's the leverage to extract concessions when you're in the minority. Republicans have done it. Democrats have done it back and forth. So why would Democrats just give that leverage away? They wouldn't. So that was never going to be in there if Democrats are going to support the continuing resolution. Nevertheless, I can't help but think from a political strategy perspective, Dylan, if I'm a Republican congressman or senator who's in my 40s, 50s, or 60s, who's going to butter my bread in 4 years' time? Trump or the guy whose net worth is 60 times Trump? Whose good graces my long-term political survival depend upon? Those of an 80, soon-to-be 83, 84-year-old man in a few years? Or the guy who's in his 50s, 60s, who's worth $350 billion and who's now curated all...
$440 billion, I think it is.
$440 billion. Okay, so Trump's worth what,
it's gone
6?
Up a bit. It's gone up.
So Trump, yeah, so he's worth 80 times Trump, right? So I
would go so far as to say Musk is clearly the most powerful human being on earth, full stop.
Probably
because he knows how to run political financing at a grassroots level, digital door knocking, and regional money in congressional races, primary challenges, all the little game that's played. He clearly knows the game. Yeah, and I think the most powerful. He's more powerful than the president.
Well, because the game is, in hindsight, obviously simple. Like, why isn't Trump knocking on doors? Like, well, because you don't need to knock on doors. Everyone has their phone in their hand 24 hours a day.
And if you know how to then fund little congressional races and primary challenges where there's never a primary, it's a huge amount of work. So basically when Musk says, if they don't do this or this or whatever, I'll fund a primary challenge to them, whoever they are. What he's really saying is I'm going to make them spend their time calling people, asking for donations of money, because the more you have a primary challenge, the more the incumbent politician has to spend all of their time on the phone calling and begging for money to deal with the Musk airwave campaign. And so just the threat of an unlimited financed primary on television against an incumbent is very persuasive for any marginal decision to go in Musk's favor, as the debt limit demonstrated. And maybe even more than marginal. It might be total control.
That makes me think that Tesla is not fairly priced at $430.
Meaning it should be more. Because it's the most powerful man in the world, full stop.
If you're working backwards from the basis that the new system of governance that we're heading into is going to be one that's more
access-based,
like more of an oligarchy than times previous, and that Musk, like, look at the muscle he flexed this week. He flexed more muscle than Trump, legitimately.
And he knows how to. He'll be like, all he has to show up in any primary and say full budget, and it just makes the incumbent life a nightmare.
Dylan, you've run a congressional campaign before. I've been on the inside.
And to do it against a well-funded opponent in a primary who's just going to make the candidate spend all of their time raising money and still get smoked.
Like he could drop $1 million into every single district and not even think about his net worth.
Oblivious. 10 million into every district.
Yeah, right. And so that's the sort of Damocles now that looms over. And I think that means Tesla's gonna be a really interesting stock for next year, right? This is not to be a Musk bashing session. I know I have historically.
But I guess the argument is that Trump has more power. He's the president of the United States, and Trump can say, "Don't get so close. Back it down." It's not just money.
And that is very true. and Musk could take his money and with Vivek and conjure up a group of people to challenge what's now
the Republican challenging system.
Yeah, and basically say these people are not, they're too enamored with Trump. They're not really trying to make America great again. We need to do these things to make America great again. Like they try to take the mantle from it, and they have the media apparatus on Twitter.
The most likely thing is this is the beginning of a techno-utopian third party. Andreessen, Sachs, Thiel, Musk. 4 years from now, there's a third party candidate. That's J.D. Vance running as the Thiel Musk candidate. And you have Republicans and Democrats. Is that still good for the Tesla stock or bad for the Tesla stock?
It's irrelevant for the Tesla stock right now because it's too far afield to really make any kind of trading decisions.
What about Vecchio's point, which is a fascinating one, that Musk proved himself as the world's most powerful man this week with the way he manipulated and controlled the debt ceiling negotiation.
This is one thing. It's one thing.
The president can't even do this.
Well, one thing.
He's technically not the president, but
and he's not the president.
Well, can we take a step back? How crazy is it that through this entire process, everyone has been treating Trump like he's the president, and Biden is just like a non-factor in this discussion whatsoever?
Well, there's that, and of course, there's also
because he is.
It's nuts, but also
crazy.
Remember,
Biden and Harris.
They always do this.
Biden created that. Biden created this. This is Biden's creation.
They always do this, though. The debt ceiling always is extended. It is always extended in the 11th hour because they're always jockeying until the last
moment. I know, Ilya, but Musk is.
So what has he done?
He's controlled the whole negotiation. He stopped the deal.
Nominally.
Recut the deal.
He nominally was present, but they always do this.
He took over the whole deal. And of course, they're going to make a deal, but he took over the term sheet and used the threat of.
Tesla's undervalued. If we're going to techno-utopia,
use the threat of primaries to influence the fact that the Democrats, the president of the United States, not the president-elect, not the current president, not the Speaker of the House, not the Senate Majority Leader, but an independent billionaire was the most influential, I think, in the term sheet to get on the last 72 hours before that thing passed, which is a remarkable show of power. I think
there is, of course, a very reasonable argument to say that Elon Musk is J. Pierpont Morgan. That this is the new kind of private sector steering node for all things. As J.P. Morgan Sr., and frankly his son as well, demonstrated over and over and over again in a prior robber.
And Tesla's cheap on the double.
In a prior robber baron age, and that this is another robber baron age. Only now it's Silicon Valley robber barons. It's not bankers and oil men and railroad men. Okay, that's possible, sure. Also, those of us of Soviet extraction walk around with a similar mindset on but one thing, and it's this idiom. The government always has one round in the chamber extra. And
that's a 2025 prediction that Donald Trump will have Elon Musk killed? Go on.
This is the simple reality that you can be as rich as you want and as powerful as you want, but unless you are the government, you're not the government.
But if you control
and Trump is the government.
But if you control the votes, you're the government. And if I have digital door knocking and grassroots campaign,
can't call early elections in the United States. Doesn't matter. If this were Europe, yes.
But I can control votes in the Congress during the tenure of the presidency on fear of primary challenge within 2 years.
Not if the president decides that you need to be relieved of your power and your money, and the president has the means to do that.
But Chris's point is that this dog is out of the barn, the horses have left the yard, whatever you want to say.
Maybe.
And that Elon Musk is going to be rich and
dogs are out of the barn.
And that
the dogs are out of the barn. No, maybe.
But Dylan, I've read enough Philip K. Dick.
Permanent voice.
I've read enough. Philip K. Dick, I've watched my Blade Runner and Aliens. Like I'm into the Ridley Scott lore. Like this is how those companies start.
Yes.
Like,
No.
this is how
this
those
could be
companies start.
Skynet. This could be Skynet.
No, this is like Waylon West. Like this is like how you get Waylon Yutani. You have someone who's entrenched interest. And listen, I have been wrong in many regards. Maybe he is still a huckster showman, and I'm right about that. But he has leveraged and flexed his power in a way that makes me think Tesla has more in the tank. And if he gets removed from Doge, forget the Kalshi betting markets. I wonder. He is also someone who is very keen on making sure that he is not like treated disrespectfully, like he's not embarrassed publicly. And I don't think that Elon would go away quietly if Trump and him met on bad terms.
And if he's JP Morgan, if this is the next robber baron age and he's JP Morgan, then it's not necessarily the case that he, in his mind, is after unchecked power for its own sake. JP Morgan, for all of his non-competitive string pulling and manipulation of the markets, in his mind was doing the benign thing and working for the good of the nation.
Yes,
he was convinced that this is what he was doing.
Because yes, why else would he open up his personal liquidity to keep the stock market afloat?
That's right.
Right.
That's right.
What a generous thing he did for the New York Stock Exchange.
What a generous, benign thing to do.
What did that afford him?
And to create massive railroad cartels, because we don't need instability, folks. I just need to have people from my bank on every board, and then everything's okay.
SMH here, up 3.14% today. Big day for semiconductors, which continue to grind into nothing for the past several months. October, November, now most of December, we've been bouncing around 240 to 250. It's basically the midpoint of the trading range from the July highs to the August lows. For those that have been range trading this, good on you. I have done that a few times in the recent months, but not recently. And that's a damn shame because just like oil prices, it's been moving sideways. Dylan, oil heading into next year, looks like there's a good deal of supply coming online. Global growth is in question, but geopolitics are basically gone. In terms of seeing what's happening in Eastern Europe and the Middle East, I suppose the most noteworthy thing is that Bashar al-Assad's wife is leaving him. Apparently, she was okay with staying his wife when they were gassing people in Syria. But once he starts a podcast and moves to Moscow, that's just a step too far.
Step down too far.
But like Syria's done. Maybe this HTS becomes a problem. Iran is going through a gas crisis right now where they've actually, over the weekend, according to reporting, were forced to decide with powering the nuclear power plants in the country or providing heat to people's homes. And they went to heat to people's homes, so the presidential palace in Tehran was without power for 48 hours. Iran's influence in the region is waning. And obviously Trump is angling for some sort of resolution between Russia and Ukraine because we've heard Zelensky making the rounds and we've heard all the talks back and forth. Putin's been on the airwaves himself saying how he's looking forward to talking with Trump. What happens to oil in 2025, Dylan? Or is this something we should stay away from?
Lower.
Why?
Because I think the U.S. administration is pro-deregulation and pro-drilling and pro-less regulatory that drives away from crude and in favor of less regulatory and more permitting that's more in favor of more supply, combined with the end of the war with Russia.
Ilya, you and I were talking about
make a lower oil price.
You and I were talking about this earlier today, Ilya. Mm-hmm. Just give the brief recap for people. Where are we looking for oil for going into 2024, or rather 2025?
I mean, I'm with Dylan on the unraveling of geopolitical risk. We can see, and folks should definitely check out the archive of that Futures Power Hour we did earlier today, because there's a chart there showing U.S. output booming. And that's with the number of oil rigs active coming down, with the number of fracking operations coming down. So the U.S. is more efficient at extracting and is able to get to more petroleum production than Russia and Saudi combined while it reduces capacity, which is incredible. If we were to increase capacity further, because the new administration seems to want to do that, then we get astronomical amounts more oil, and we start to export even more because a lot of the oil we produce, we can't refine. We refine a different grade of oil. So we're going to start to flood the market with oil and gas in particular. So that's a thing. Geopolitics, of course, is on the wane because Iran is losing its entire network. Hamas in shambles, Hezbollah in shambles, Syria off the board. Among other things, how do you resupply a Hezbollah, for example, if you can't move the arms by land across Syria because you don't control Syria anymore? I don't know how. You certainly can't ship it. Iran doesn't control the shipping lanes. The U.S. does. So you have an issue here where Iran probably sits down and doesn't aggravate anything for a while, which is to say, if Israel, the U.S., and Western powers more generally are engaged really in a contest with Iran, Russia, and their proxies in the Middle East, there's probably not escalation from the Russia-Iran side here. Russia is busy. Iran's defanged. So you probably have less geopolitics as a premium for risk in the price. You take that out, and the supply-demand story is oil abundance. So I'm with the short. I just need the price action to start to recognize it.
Ilya, before we go on here, just want to remind everyone, Tom was talking about this trading hours on last call. The trading hours this week for the futures market, at least, they are a little bit staggered. If you're trading equities and interest rate futures, ES&Q, ZBZN, they close at 1:15 Eastern, 12:15 Central Time tomorrow, and they reopen at 6 p.m. Eastern, 5 Central Time on Christmas night for the Thursday trading session. Thursday, regular open, close there. Crypto, FX, energy, and metal futures, they close a half an hour later tomorrow, 1:45 p.m. Eastern, 12:45 Central Time. And then they reopen same time as everything else, Wednesday, Christmas night, 5 p.m. Central, that's 6 Eastern. Grains, livestock, CFE, that's the VIX. You're going to see some staggered times as well, but the VIX futures are closing same time as your equity and interest rate futures. So next 2 days, odd schedule, not atypical for a midweek thing, just like you would see around Thanksgiving or so. Geopolitical risk seems like it's at a low point. I mean, Tom was bringing this up before as well, how, people talk about the wall of worry, Dylan. What's the wall of worry for next year? That's kind of like, that is one of my sticking points.
U.S. government policy, unpredictability because of new people. That's the number one new risk for the world.
If this is such a risk, why isn't gold going up more?
I'm not saying it is a risk. I'm saying that is the only material change in the chessboard where risk can emerge.
Because gold is not a safe haven, and if you thought it was a safe haven, change your mind.
I suppose that's one way of going about it. Why? China's buying gold again. Where's the enthusiasm? Yes. Is this just a dollar and yield story at the moment?
I think it's a dollar and yields and China story together, because if you look at what's been going on here, you see gold in that very tight range starting December. It busts out of that range on the top side because of the China story. It comes back in because of the Fed story. It's basically reset into that range now. So we now have gold basically unchanged for all of its various swings in December, back to where the month started, a narrow band where it's looking for how these forces balance. If the Fed story is indeed that the markets overcooked it on the hawkish side, and indeed, look at the economic data, it's turning. So if that's what's going on here, then, and you get a weaker dollar, you get lower yields, and you get a China buying that the numbers continue to show when we get the December numbers for FX reserves, well, then all of those things fall on the same side of the equation. And I think that's why you see gold actually holding in this range, broadly speaking, going really to the beginning of August, where that support is with that gray line across the screen, as opposed to what's going on with bonds, as opposed to what's going on with the dollar. If gold were only a creature of the dollar and of yields, as it historically is, we would be getting a gold that is collapsing right now. Certainly since August. And we're not. It's holding up. And it's holding up because China is buying. And I don't think anybody really cares about geopolitics that much. I don't think that's really a major contributor to this story. Because if it were, then crude oil wouldn't be on its back. But it is. And so when we look at this whole thing, I think it's the China buying and the Fed story coming into alignment with higher bonds and a weaker dollar that ultimately catalyzes gold higher, and probably by a lot.
We were asked what we thought looked pretty weak going into the next few days. I mean, silver prices are up by 0.84% today, but with gold teetering the way that it is, and it's starting to try to creep below that uptrend from the July, August, November swing lows here, seeing a little bit of damage done to that uptrend. I noticed that silver prices, they're rallying back to, but not getting over the neckline in this potential topping pattern. So if we find ourselves on the other side of the 1 week moving average, $30.57.5 per ounce, that does take you through that uptrend that we lost, get you back above the neckline, and that negates the potential topping, at least momentarily. Of course, it could reverse lower again. But in that case, you then have all right, we've warded off a bearish breakdown, trade back to the other side of consolidation up towards 32.5. You have a reason to press on those longs that I was looking at getting filled and did not last week, thankfully. That would probably mean that gold holds up here. I find this area around 2,600 to be like, that's the line in the sand. The pre-FOMC swing highs that you have in August, the low that you have on September 18th, right where the closing lows are in November, and we find out that China's starting to buy again. And sure enough, we haven't been able to move back below there since that information was revealed to the public. So below 2,600, you got a problem on your hands. But between gold and silver right now, they're kind of in a no man's land. And that's a tough trade to operate around in thin markets over the coming days, which, speaking of coming days, there are some treasury auctions this week. Today's 2-year note auction was pretty strong. In fact, highest foreign demand for 2-year notes that we've seen over the past 6 months. When we look out along the curve, one of the seasonality being something that happens, a pattern within the data. In this case, whenever you have holiday periods with auctions, the auctions are typically some of the weaker ones during a 6-month look back window. Just people aren't around. So if you see weaker treasury auctions this week and next week in particular, I don't read into it too much. The market is already telling you enough. Volatility is starting to go back up as prices are going down. Today you had a good number come across the trade desk and no one really cared at the end of the day. But we're looking at closing lows now for ZN and ZB here. We already brought up the chart that we have for TLT positioning. What's the most efficacious way to play this, Ilya? If you want to be a person who says, you know what, I don't know if this market's going up, but I know when it's going to go up. Rather, no, I don't know when it's going to go up, but I know it's going to go up. So it's not a question of if. I want to get some long delta exposure here. Thinking about that TLT chart that we shared a few minutes ago, how does one position themselves to do so for, say, like a trade for the first quarter?
I think if you're looking at the various flavors of this, because there's expressions of this idea across various assets, I think actually looking at it in FX first becomes attractive, because the price action in something like the euro, for example, looks a lot better to try to play for a bottom, because you've already started to put that in and you have a clear risk reward matrix with at least a 2-to-1 risk reward setup, basically saying that low is going to hold. And I'm really only looking for the swing high on that range. So let's say I'm looking back at getting to, let's say, 108, for example. Or even something lower, even just the very, very top of that immediate range around 106.40, 107. Even that gives you attractive risk reward here, whereas the bonds have not made a similar turn. So if you want to look for something now and lay something on, a micro futures contract, even one that's not options based, low margin, doesn't tie up a lot of capital, doesn't move wildly like something less liquid. The euro, of course, the euro USD exchange rate, which is what this is possibly the most liquid financial instrument in the known universe. So this is not going to move erratically like some other things, most likely. Unless, of course, Martians land in Paris or some such thing.
Why not just be long the bond? Why get messed up with a second?
Because the bond hasn't shown you a sign of a turn yet. I am long the bond, but it's bleeding out. And I'm holding it still because I have a vertical on, and so I'm at max loss, and it's a very modest max loss because I've locked it in that way, only at about 1.5% of account equity. So there's really no reason to mess with this. Would I lay it on fresh now? No, because there's no signs of a turn here yet. Once there are, there are. In the currencies, signs of a turn are occurring, which give you a low against which to benchmark risk. And to say, if it's below this low, I'm wrong. Whereas here, who knows where that is? Yes, sure, you can look at the swing bottoms from mid-year and say, that's the line in the sand. You could do it that way. But in currencies, you've already started to turn. So at the very least, your risk-reward calculus has meaning.
Currencies have started to turn a little bit, which is noteworthy here because so many of them have been dogs recently. The yen, of course, is staying on the floor today. This is something that I may need to manage soon, so maybe I won't be done trading. 11 days to expiry. Kind of bleeding out here. Need 30 more pips. Show me the money. This was the trade that was taken back in September, Dylan, when I was being jocular and saying the BOJ is never going to raise rates again. This thing is going right back to where it was earlier this year. Wish I had a little bit more time on my side because this data bleed is hurting me. But if we get 30 more pips, it was a good call. 0064 puts. We're currently at 0064.29. That was put back on. We're trading closer to 0070. The yen isn't a typical currency that has, it's not like an emerging market currency. So I don't know if we want to view it through that kind of lens. But some of these other currencies, like the British pound, the Canadian dollar, the Australian dollar, they're showing some more issues that I wouldn't call them emerging market currency behaviors, but they're certainly things that happen to currencies, or they're hallmarks of currencies that are facing some sort of crisis or issue, like current account external financing problems. If you see drops in foreign direct investment, looking at the lack of export growth, thinking about a country like Canada, for example, how is the U.S. domestic economy so strong and one of our largest trading partners not benefiting whatsoever, right? That's a problem for the Canadian dollar as we go into 2025.
And the dollar and the pound both show it. You do wonder about are the dollar and the pound actually also likely to go down another 50%? Like, are they just going to become second-class currencies over the next
dollar? I mean, dollar obviously no.
No, I mean pound,
Canadian dollar.
Oh, I mean Canadian dollar. I think obviously no, because you're attached at the hip to the U.S.
It's been getting weaker. It's been the Canadian dollar ain't what it used to be, sir.
Well, no, of course, and it's because the U.S. economic boom has not spilled over even into Canada, right? Because everything is going on.
And the British pound, it's the same or worse. The domestic economy is isolated.
Believe it or not, the pound is actually the least worst performing major currency this year.
So this is the interesting thing. In the UK, you just not only had a situation where inflation was high and growth is weak, which is madness for the central bank. That central bank has had a chance to opine. We had a Bank of England policy announcement last week. They were dovish. They picked growth over inflation, essentially, as the main concern, and the pound still couldn't sell off. That's a sign of tremendous underlying strength eventually. We'll have to see. The situation with the Canadian dollar largely exists because the U.S. economic boom is centered on services. And Canada exports mainly goods. And in fact, most things the U.S. imports from anywhere is goods, not services. And all of the boom then is primarily benefiting domestic firms. However, we have the largest split, looking at PCE data, of demand. If you want to look at inflation pressure as a proxy for demand, more inflation pressure, more demand, we have the biggest tilt favoring services over goods in 2 decades. This is going to correct eventually. U.S. consumers will want stuff eventually, and not just services. So I don't think Canada is going anywhere fast as far as becoming a second-class citizen in the G10, but certainly their current issues are multitude. Political chaos, essentially a lame duck administration, even without calling an election or losing it. They're effectively out of power already. And an economic situation that's dire. So, no, I don't think Canada is going to fall off the map. I think ultimately the proximity to the U.S. will be a benefit, and North America as a whole, U.S., Mexico, and Canada, will be the powerhouse over the next 5-10 years. Today, the Canadian situation, shorter term, looks awful.
Well, once Canada is the 51st state, or 52nd because we're getting Greenland first, maybe 53rd once we invade Mexico. I don't know. It's so hard to keep up with all the craziness these days.
It gets complicated. It gets complicated.
Yeah, but, it's quite the way to end the year. Dylan, Ilya, it's been an absolute pleasure working with both of you gentlemen this year. I'll see you both in 2025. Happy holidays.
Thank you, Chris. And Merry Christmas. Merry Christmas. And then, Ilya, I'll see you on Thursday.
Yes, sir.
For my friends and colleagues, Dylan Radigan in Milan, Ilya Spivak in San Francisco, I've been Chris Vecchio in New York. Overtime is out of time for today, and I'm out for the rest of this year. So good luck trading. Dylan and Ilya here on Thursday, Monday, and Thursday next week as well. So be sure to tune in. Otherwise, happy holidays and see you soon. Stay tuned, though, because Tasty Live is still on next with Macro Money and Ilya Spivak.
See you there, everybody.
Rock, paper, scissors? He just played paper. He'll do it again. No, rock. Men statistically play rock, but he played paper and lost, and the mind works in patterns. He's going scissors. He knows I know he'll go scissors, but knowing I know he knows.
Scissors, shoot. Thought we were doing rock, paper, scissors, shoot.
It's always rock, paper, scissors. If you think like a trader, we've got your back. Tasty Trade. Join the club, genius.
I started trading around 2018, as soon as I got out of college. Stumbled upon a couple of different YouTube videos and learned that way. Truth or Skepticism with Dylan Radigan was actually kind of what really caught me in the early stages, because Dylan was sort of the skeptic, and like I was a skeptic as well. And Tom was able to sort of convince him, and that was kind of my favorite show from the beginning. The fundamental principle that present fear of future uncertainty is fundamentally overpriced. In other words, volatility and selling volatility is the key to getting a statistical advantage in financial markets, is the biggest takeaway. And that's kind of just the overarching principle I follow.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with tastytrade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the tastytrade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Decision to build Thinkorswim was a byproduct or derivative of 20 years. In our minds, the future of finance meant that we were going to move away from something that was very manual and move to something that was tech-driven.
What we did with Thinkorswim truly changed the industry. To do it a second time was a challenge that I just had to take. The platform is just leaner, cleaner, a little meaner, legitimately built from scratch.
Want to know what you're getting into before you dive in? When you trade options at tastytrade, you see your probability of profit and loss right where you need it. tastytrade. Make your move.
Dear Chad, thank you for trusting me with the workload of 5 people this week. It was an invaluable learning experience. All 97 hours.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
You made me print out something for you in 40-point font.
From the smart mouths at tastylive.
What a year it has been. 2024 has obviously been a year of many, many headlines, tons of market volatility, explosive moves for a whole host of financial markets, and it now winds up on a quiet week with not much macro to speak of and a holiday in the middle for most global markets. So what we're going to do here on Macro Money is look ahead to what is coming for 2025. I'm Ilya Spivak, head of global macro here at tastylive. And what we're going to do here is first, we will review how the year has progressed so far. Take a look at some almost over statistics for market performance, and then see how things begin to look as we enter the next calendar year. So this is the performance year to date. This is December the 23rd that we are looking at this 2024. So not quite the full year, but almost certainly, and comparing it to 2023. So we can see stocks on the whole had another year and a year of similar performance in 2023 versus 2024, looking at the S&P 500. NASDAQ, for all of everybody's screaming and stomping about its outperformance, it's actually done less well this year than last, though, of course, still a very impressive rise of nearly 28%. Risk sentiment at the other end of the spectrum getting a big boost, looking at Bitcoin up 120% as compared with the prior year's 157 almost. So a bit of a slowdown there, but certainly a dramatic increase again, and that speaking to the risk appetite on display in stock markets, but of course amplified by a less liquid speculative assets volatility profile. The interesting thing here happening in the meat of the table, though, so we can see yields basically unchanged at the front end, but a touch higher on a year when the Fed is actually cutting interest rates. The 2-year up 2.3% on last year. That's most likely because, of course, speculation for rate cuts was already well underway toward the end of last year. And this year we got just about the rate cuts we were expecting. So yields are even a touch higher. The 10-year showing a much more significant rise. So rates at the longer end of the curve steeply higher by comparison, 18.8%, almost 19%. Curiously, in that environment, the dollar is stronger. Euro down 5.7%. The yen, the most interest rate sensitive of the bunch, down 10.4%, even as the Bank of Japan started raising rates, the only major central bank to do so. And even stranger still, against an environment where yields are higher and the dollar is stronger, gold up 26.8, almost 27%. This is an asset that hates a stronger dollar, hates higher yields because it is a natural foil for fiat currency, and it yields nothing. So when interest rates go up, gold is typically on the receiving end of selling pressure. Not this year, though. There's an interesting recharging here happening, and the mix of assets here seemingly telling us an interesting story. Crude oil, before we go on here, down for the second consecutive year, albeit less so, and that's despite ongoing geopolitical stress. This telling us that perhaps that geopolitical stress, not much of a disruptor for crude oil markets beyond general media headlines. And so the implications probably limited now that geopolitical risk seems biased to be more contained going into 2025 versus less at the beginning of the previous year. The situation in the Middle East, the situation in the Russia-Ukraine theater seemingly not inspiring any kind of concern for crude oil, and it's marching to the beat of its own drum, and that beat is leading it a touch lower. But the story in stocks, coupled with the story in rates, coupled with the story in currencies and gold, tells an interesting tale. It tells a story of a robust U.S. economy, which despite Fed rate cuts has driven up yields because economic activity has demanded that rates be higher, especially down at the longer end of the curve. The dollar has continued to benefit from those higher yields as its yield profile against other currencies has looked more attractive. And gold has seemingly found a reason to go up, disconnected from geopolitics, because, of course, if it was a haven and if it was behaving as one, it would show up in crude oil gains. That, of course, the chief geopolitical risk on the board this year. And clearly, if oil doesn't care, why should gold? And indeed, gold is up with stock markets. Not much of a haven then. But gold seems to have found its support in the situation happening in China. They've bought a ton for their reserve account. They have resumed buying in November after a pause from April. And that's been an important reason why gold has managed to hold up, even as the dollar has strengthened, even as yields have gone up. But that increase in yields and that stronger dollar with stronger stocks seems to speak to the very impressive performance of the U.S. economy. As we look here, we can see as of December, the U.S. economy raging higher. The performance here being estimated by PMI numbers. They're more timely than GDP. We can see here that toward the end of the year, the composite index, which takes in both manufacturing and services, it's moving aggressively to the top right side of the chart. As a matter of fact, that is the fastest growth that we have seen in the US since March of 2022. So a very significant acceleration here. As ever, these PMI numbers work around a center line of 50, where that's neutral. Above 50 is growth. Below 50 is contraction. Manufacturing, we can see, is still in contraction, albeit at a modest speed. The further you go under 50, the faster the contraction. The further you go above 50, the faster the growth. So we can see a very buoyant service sector is pulling the U.S. economy higher, and slight contraction in manufacturing is not holding it back. That ostensibly helps to explain how you get very strong stock markets, you get higher yields and a stronger dollar, even as the Fed cuts rates. But when we look at the situation globally, we find something much more circumspect. Take a look from the beginning of this year for the global PMI numbers that include the US, of course, but also the other economies. And what we find is we haven't done a whole lot. The composite index here, only very little change. There was a pop in the first half of the year. That pop has since fizzled. And so the pace of economic growth is just about where we started the year. It has seemingly stopped improving. And that's because the global service sector has taken quite a few steps back since the middle of the year. And manufacturing, although it was much worse earlier than it is now, it seemingly has returned back to the neutral reading of 50. It nevertheless remains downbeat the world over. So what's going on here? Well, we see here, of course, that the U.S. is mainly powered by its service sector, and we know that most of U.S. imports, that is, from the world at large, are on the good side. Services are mainly furnished by domestic firms. So a lot of this boom is staying inside the U.S. and not spilling over, even to very close proximity, very integrated economies like Canada. And so this is why the global picture looks much more anemic than the U.S. one. Now, global GDP growth is mainly dependent on three core economies. The U.S. is, of course, the biggest one. And then there is the Eurozone and China. We can see here that the remaining 42% to those three economies, 58%, are mainly vendors that depend on demand from the former three. So think Canada and the U.S. or Mexico and the U.S. Think Southeast Asia or the commodity exporting countries in South America, Australia as well, New Zealand as well, and China. Think Central Europe, Nordic Europe as vendors for the Eurozone. And you can see that these three economies are really the linchpins of where growth comes from. And we've already seen that the U.S. is very strong. The situation in the Eurozone is much more sobering, as we can see. The regional economy shrinking for the past 2 months, the composite index sub 50, even as services rebound in December. The situation in manufacturing, as it is globally, anemic, but the rebound that we saw in the first half of the year, and arguably a big reason why this global number started to pop by mid-year, that has fallen away. And now the economy is again flirting with recession-like conditions. The situation in China is one of standstill. These numbers run through November. We haven't seen December's figures yet, but as we can see, these are official figures here. This is China's reopening from zero COVID restrictions. We get a brief pop in service sector and composite demand. The pop in manufacturing much more modest. And since then, after just basically a quarter of an initial upswing, the economy drops and settles into standstill. These numbers are barely removed from the center line at 50. So in one major node outside of the US, we've gone basically nowhere in 6 quarters. Indeed, the economy is in deflation mode, where real GDP is outpacing nominal, suggesting that there is virtually no demand to speak of. And in the other, we've returned to what can become recession-like dynamics. Once again, after this shallow recession-like dip late last year. So the world is operating on what is essentially one leg of the stool. It is the US that is powering global growth, and there is no plan B as we go into 2025. Where this becomes a challenge is in the US, inflation has stopped cooling and is starting to tick up a little bit. The most recent numbers for the Fed's favored inflation gauge, the PCE index, showing that we're holding at 2.8% on core, and the headline number even moving higher, albeit a little bit less than expected, to 2.4%. Now, this is, as ever, we can see having to do with the service sector being as strong as it is, core services where that inflation lives, core goods still slightly negative in their contribution to price, which of course tells you why the US boom isn't spilling over, as we've just mentioned, and housing still largely locked up by what the Fed has done with hiking rates as sharply as it did in 2022. So that bit is waiting for the central bank to cut rates more and perhaps unlock this market. But as we start to get a tick up in core inflation, and indeed at 2.8%, what this means is essentially we have not seen disinflation in the US of any kind since June. June was the last time that we ticked down on core year-on-year PCE. Since then, for the subsequent 5 months, inflation has not fallen. And so what we understandably have seen as a response is the Fed has become more hawkish. The markets have called for it, and the Fed has responded. We can see here that where the policy curve looked like it was going in September has been adjusted substantially to a more hawkish setting, even as the Fed began to cut a little bit in the waning quarter of the year here. Of course, 50 basis points cut in September, a 25 basis point cut in November and December, respectively. Nevertheless, the path forward now much shallower. Rates expected to be a full 100 plus basis points higher, closer to 4 than 3 by the end of the year, because inflation has proven stickier. Now, it's possible that the markets have overcooked this a little bit, because we can see that since mid-November, U.S. economic data has actually been cooling relative to forecasts. So maybe this adjustment has gone a little far. Maybe the markets are a little bit too hawkish, bonds a little bit too weak, rates and the dollar a little bit too high. But none of that changes the inflationary path. So although the markets might be wrong by a little, they're probably not wrong by a lot, and they're probably not wrong about the trend of adjustment here. So we're looking at structurally higher rates next year in the US than we thought even 3 months ago, 4 months ago, and by a significant margin. This, of course, represents a problem not just for the US, but for the world over. So we can see here in the latest numbers from the Bank of International Settlements And 2022 is the last time they had an update. There'll be another one next year. They do this every 3 years. But these numbers don't change terribly, especially when the disparity is this large. Notice almost all global monetary transactions are settled in the US dollar. Those of you that have heard various chatter about the BRICS maybe coming up with an alternative should look at this sobering total here. This is all of the turnover moving through the BRICS, of which, as we can see very clearly here, most is China. And everything else, India or Russia or indeed some of the others are clearly a pittance comparatively. Here's South Africa right here. So, and of course, there's Brazil. So most of what's here is settled in dollars, and that's because the dollar is so liquid that it is sometimes cheaper, even when there is a bilateral deal to transact from one non-US dollar economy to another. It is cheaper sometimes to trade that currency for dollars and dollars into the third currency versus to do a bilateral deal, because the liquidity of the dollar is so abundant that that's the cheaper way of trading. So not surprisingly, almost all global commerce is settled ultimately in dollars. And what this means is that if the Fed gets a little bit more hawkish and rates don't come down by nearly as much and dollar credit is more expensive, then global credit costs are higher in general. And we can see that as we look at the way that an average of interest rates from the key economies in Europe and the Asia-Pacific region, Germany, UK, Australia, Japan, the top four outside of the US, how their interest rates have moved in lockstep with the US 10-year, even as central banks in the UK and in Germany have cut. The Bank of Japan has hiked. The Bank of the central bank in Australia, the RBA, they've done nothing. But even as that has happened, the rise in U.S. yields has brought a rise in the average of the other four of the alternatives. And that just tells you how ubiquitous the dollar is in global trade. That, of course, sets up a very interesting situation for 2025, where the robust performance in the U.S. means higher rates in the U.S., but also higher rates on weak economies that are not seeing the boom that the U.S. is seeing. Moreover, since the world is dependent on a single point of failure, the U.S. economy's economic strength, it is certainly a point of interest that interest rates are set to be higher there, even just locally, because, of course, that would perhaps start to hold back U.S. growth, and to that extent, hold back global growth because there is no backup. So the risk to global economic performance is a significant thing to keep an eye on, and a significant risk for markets as the calendar turns to 2025. Moreover, the stock of global growth is huge by any stretch of the imagination at a time when interest rates are going to end up higher than expected, it would seem. We can see here the full breakdown from the IMF. We find that in debt to GDP terms, because, of course, debt is not scary in absolute, it is only scary if you can't afford it. And debt to GDP tells you how affordable is the debt, are you producing enough economic growth to service it? And of course, in the COVID years, we can see there's a massive surge for global debt as well as for the major economies, the emerging markets, the US and China. The change in global debt was significantly lower in the subsequent years because inflation was roaring and inflating that debt away relative to growth. Well, that seems to have stopped for the world in 2023, where public debt is starting to grow a bit. That's mainly powered by what's going on in the US, of course, and China, and to some extent, emerging markets. But we are now in a place where inflation has come down a lot, almost everywhere, from double digits or close to them to levels that are much closer, if not quite at, central banks' targets in the sort of 1 to 3% range, depending where you look. And with that, the shaving away of debt relative to GDP, so the affordability improvement that we saw here and here and here and here, is ostensibly over. If you were to find yourself in a global scenario where the US buckles under higher rates, where already weak economies outside of the US have to deal with those higher rates without the benefit of stronger growth, you start to see how a treacherous debt risk starts to emerge. This is made that much worse because this particular US tightening cycle has been unique since the modern era. This is a chart from The Economist going back to 1972. Very important look back period because that's right around when the modern financial system as we know it is born, with the uncoupling of gold and the US dollar and the dawn of the fiat era. So what we find here is that in every other tightening cycle, they're listed here, the outlays by non-financial firms, that is regular businesses, on credit increase when the Fed raises rates. That's, of course, exactly the idea. The Fed is looking to slow inflation, slow the economy, and so it's raising rates to increase how much firms are spending to borrow, to discourage them from borrowing, and cool the business cycle. The 2021 to 2023 rate cut cycle has not done that. And the reason it's not, the reason that actually credit outlays mysteriously are falling even as rates go up, is because during the COVID years, everybody gorged on cheap credit. Well, that cheap credit comes due mainly next year and 2026, and at interest rates that are 200, 300, 400 times those that were incurred. If this happens at a time when GDP growth slows because rates are already high and going to be higher than previously anticipated, then of course debt affordability is that much scarier. Couple that with the most bullish disposition for risk sentiment that could be imagined. A survey here from the Conference Board showing in the US the percent of respondents expecting stock prices to be higher next year, off the charts. The allocation to equities has only been higher all the way back here at the start of the global financial crisis, and then back in the dot-com era. The allocation to cash has never been lower, looking all the way back to the second half of the 1990s. And so what we find here is tremendously robust risk appetite, which of course is clearly on display when we look at this performance. Now, given the risks, one has to wonder. Optimism is always highest at the peak. This is by definition the peak. But is this the peak? Or could optimism continue to build? It certainly could. But the way the table is set, one does have to wonder if indeed we've reached that peak or close to it, and if equities are in for a rude awakening next year as markets digest all of what's ahead. And that is macro money for today. as ever, we are here right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. It is a holiday-shortened week, but we will be back on Thursday after market closures around most of the world, and we'll have 2 shows for you next week as well around the New Year's holiday before we come back to regular scheduling. You can follow me here and, of course, opining on the platforms formerly known as Twitter, as well as now on Blue Sky at Ilya Spivak. Thanks for watching. Have a great holiday, whatever you happen to be celebrating. Macro Money will be back on Thursday to finish out the week.
All right, we're back. Tasty Crypto Show. I'm Ryan Grace. With me today, of course, Katie McGarrigle. Where do I start? Crypto for Beginners, episode 9.
Niner.
How are you?
I'm doing well. How are you?
Yeah, pretty good.
Yeah?
We're getting through the week, right? It's hump day, Wednesday.
Cruising?
Yeah.
We're
I like
not
Thursdays.
boozing, but we're cruising.
Not boozing yet.
I saw they popped some bottles out there.
Without us.
Without us. How rude.
Per usual.
Yeah, I know.
We always get left behind, Katie.
I know. Maybe there'll be some leftovers when we're done.
Maybe.
We can only hope.
Katie, we got to shout out the chat. We're streaming live on YouTube. If you're watching anywhere else, get over to YouTube if you want to type something crazy into the chat. Grumpy Mike, what up? VW Diesel Dork, what up? Those are the only 2 I see thus far. So if anyone else types in there, I'll scream out your name as well and say, what up? Where do you want to go first, Katie? This is going to be the last episode of Where Do I Start? I think you're going to continue to spend some time with me on air. We've got a lot of exciting things planned for next year, but it's going to be our last show of, I guess, pre-Christmas season. I'm out next week. I don't know what your plans are, but I'm not doing this show. Okay.
That's okay, though. You know, it gives people a chance to miss us.
Yeah.
You know?
I'm sure
you
we'll
want to,
be missed.
like, have a little mystique, a little, I don't know, je ne sais quoi, so that when we come back, it's going to be even better.
Coming back, bigger, faster, stronger, 2025. This will be the last one for a week or so, but we will be back on Monday the 30th. Last episode of Where Do I Start? We're going to talk about DeFi, liquidity pools. We talked about Uniswap a bit on the last show. Before we do that, though, a little bit of volatility in the market today, Katie.
Indeed. A little choppy chop after that little FOMC announcement.
A hawkish rate cut, as I understand it, and everything's unraveling. I personally think this is a dip to be bought. In crypto specifically, but in other areas of the market. How are you thinking about things over the last couple of hours? Because this is pretty quick unwind. I mean, the VIX went to, almost 30, maybe almost doubled.
Yeah.
3% down in the S&P. I mean, that's a big move post FOMC.
When you get the text from your dad, like, hey, what's going on? That's when you know.
That's when you should be buying the dip.
Maybe.
Yeah.
I mean, I'm with you.
The fear is real.
I think I don't think that Santa Claus. Mikey said it earlier in one of our side chats. He's like, Santa Claus fell off his sleigh before the rally. I'm with you. I think he maybe just lost his footing a little bit. I think we will see a little bit of a rebound. But as far as crypto goes, I wanted your thoughts on that because this is my first. I'm trying to think of when I bought like my first little bit of like Bitcoin or ETH. First or second FOMC announcement. And this is obviously the first one I feel like we've had a material reaction.
Yeah.
So what are you thinking in terms of like how does it normally work when you see, these larger market moves in terms of like correlated assets kind of all falling at the same time? Or do you just tend to see a little bit more volatility in terms of price action?
You definitely see more volatility with the price action. I think as a result, you see the correlation strengthen. So there are periods of time where we see this positively correlated. There's a strong positive correlation across risk assets when you're moving higher. Right. You do see that at times. But like everything else, correlations go to 1 on those down moves. So you have a risk-off move. There was a catalyst today. Jerome Powell, FOMC, interest rate cut, but maybe not as dovish as everyone had priced into in terms of the forward projections into the market. So you see that correlation strengthen. How long does that last, though? No idea. I don't think it persists. I can look at pockets of crypto right now, some of the areas that we've talked about that are interesting, whether it's in memes or it's in these AI agent tokens and other areas of the market that, in some cases, we've got stuff that's up 10 to 20%. When I look at the move to the downside, well, yes, everything is selling off. We were down a lot more in percentage terms, a couple weeks ago.
Right.
Down 4.5% right now. So a little bit of a recovery. We've got ETH back towards 3,700. This is kind of normal course of business. I think if you're, excuse me, I've got something popping up in my chart. But yeah, just looking at a couple of things here. I mean, we've got TradingView up. So what? It takes you to the bottom of the range off of the top of the range. We're going to ping back and forth in between that. We were here just a few days ago when you look at Ethereum. If we go back to Bitcoin,
Right.
Same thing. I think your range is, probably 105, 95, 110 to 100. But I'm looking to buy pullbacks here.
Okay.
Still structurally very bullish. Aside from the fact that, maybe caught a little bit of levered longs off sides with the commentary here following the FOMC. I don't think anything has changed necessarily.
Yeah.
Could this be a redo of, I think, 2018 in December?
Oh, yeah.
We were, this was, I think, the Fed hiking or attempting to hike and then kind of had to reverse that. There was a little bit of volatility in the market. Maybe it's something similar to that. I don't necessarily think so. I think when you look at the kind of more macro picture, still pretty supportive from that kind of growth inflation perspective. So yeah, again, just long-winded way of saying, I think you have an opportunity to buy the dip. Does that dip extend into the mid 90s? Possibly. We know again that Bitcoin can move 10, 20% in a week. So down 4.6% on my screen right now isn't that crazy. I don't think you rush into it, but in terms of how you think about it, I mean, maybe that was it and this is the beginning of the end, but I don't think so.
Yeah. I tend to agree with you. We'll see, right? I mean, and the interesting thing about this is that it trades 24 hours. So, like you're saying, you don't have to have like this lull period that like the futures are closed right now, right? And so is the U.S. market. So you can just keep watching it all night.
That's a great point too. And I want to expand on that, and that this is not just a U.S. thing. It's not the S&P 500. It's not a single stock. Do things like interest rates have an impact? Absolutely. We've done some research previously looking at this, though, and there's not that strong of a correlation. Over time, this stuff has gone up. So with a limited data set, it's hard to find a very strong relationship given that it's trended higher and you have volatility in between. Some FOMC announcements, it's up a lot. Others, it's down a lot. But there really isn't a strong correlation between that announcement and what happens, within the moments thereafter or the following day. We can't forget, though, that this is global. It's an internet digital asset. Yeah, rates matter. The Fed matters. Absolutely matters to global markets. But so does, Chinese liquidity, liquidity out of the ECB, what the Bank of Japan does, what the Bank of England does. Like those things matter too. And so again, I just want to reiterate the point that this is so much more global in nature that I think Fed interest rate decisions probably matter less over the long term. Like, you remember what happened in the S&P, the last FOMC decision? Like, do you even know if it went up or down?
I mean, I'm assuming it probably went up teeny tiny bit.
I don't know. I don't remember. But, I think you kind of apply a similar perspective here.
Exactly.
I don't think this was a make it or break it FOMC announcement for the future of Bitcoin.
Yeah. Well, something that I want to reiterate really quickly before we actually get into the meat of today's topic is that we have a couple of new digital events live on tastylive.com. And one of them, if you are just tuning into Where Do I Start Crypto Edition for the first time, Ryan is actually going to be doing our January digital Tasty Live event. So everything you wanted to know about crypto, but we're too afraid to ask, hosted by you, I'm super excited for it. You can also sign up for 2 other events that we're going to be hosting in February and March. Yeah, look at that. Great pick of you.
Not bad. They found one good one.
Hey, trust me, there are so many like
It's the lighting.
awful pictures that are probably floating around after having been here this long. But yeah, sign up, tastylive.com/events. It's free. You will get access, of course, to like the airing of the digital collectible, and it will be given to you as a collectible after the fact.
Yeah, you can see the others here that are coming in 25 as well. We got Dr. Jim, Mike, his friends, and his whiteboard.
Yeah.
So,
I wonder who
good
his
stuff.
friends are.
I don't
Guess
know.
we'll find out.
Yeah, I'm excited to meet his friends.
Yeah, I'm excited to meet his friends too. I'm excited that he's reviving the whiteboard though.
Hell yeah.
It's going to be great. So, anywho, I just wanted to give you that quick little plug because I have just gotten so much out of this, very short series with you. I'm looking forward to continuing it as we kind of enter 2025. But if you want to get caught up while we are, in a lull period, you can, of course, rewatch all the archives that we've already done, and then you can catch up again in late January.
Yes.
It's going to be dope.
Well, you want to wrap things up, talk a little bit more about DeFi, Katie.
Yes, I do, because it is still an elusive space to me. I sat in with a meeting with you and Shelly and Tom today, and Lawrence, and I think I got like every third word.
Okay.
So I'm excited to continue to discuss all of the applications and uses of DeFi. So what are we kind of talking about today in that space?
I want to throw up the slides here, and today I want to talk about the other side of what we illustrated on Monday, and that was decentralized exchange. On Monday, we talked about decentralized exchange, trading tokens on a permissionless peer-to-peer basis through a protocol, a platform, whatever you want to call it, but in this case, Uniswap, trading through the Uniswap decentralized exchange as being a very pure form of DeFi. What represents DeFi? We're talking about decentralized finance and this concept. Here's a real use case, which is just trading tokens, but without a brokerage firm, without the New York Stock Exchange, without some of those traditional intermediaries or counterparties that you would think of. Instead, it's just using smart contracts, using code. Mm-hmm. So we talked about that. We hit on Uniswap a little bit. I want to talk about where that liquidity comes from and how you can also participate in DeFi as, I suppose, a market maker or a liquidity provider. Mm-hmm. And you can generate yield by allocating your capital to facilitate the trading process.
Okay.
In the same way that you have market makers that facilitate the trading process in the traditional sense, you can play a similar role on chain as an individual. And it can be quite lucrative.
Okay. I'm curious. Tell me more.
All right. Real quick primer on Uniswap, decentralized exchange built on Ethereum. We've talked about this last show. We've talked about this many times on the show. You can swap tokens. You can also provide liquidity. You need to do that from a self-custody wallet. You have to have control over your keys. You have to be able to sign the transaction yourself, and that gives you the ability to interact here. So you need a self-custody wallet. You plug the wallet into the exchange, connect it to the exchange, however you want to think about it, and then you can participate in this way. A couple high-level things, more jargon, stuff to explain here. This uses an automated market maker model instead of a central limit order book.
Okay.
So there's not really a bid-ask in that sense. Yeah. You have a single price. Yeah. That's through an algorithm. Automated market maker is the model.
So is there slippage? Is there arbitrage?
There is, yes.
Okay.
Yep. All those things exist. And all those things help to, in some ways, keep the market in line. Arbitrage opportunities do for sure. You interact with smart contracts to execute trades. We talked about that. You don't have a counterparty. You just interact with the code base, if that makes sense. Yep. It's non-custodial, self-custody wallet. You maintain control over your funds. So you don't have this risk where the exchange is the custodian in the way that FTX was, right? Mm-hmm. So you are always in control. You're just using this application, but you remain in control of your capital. It's trustless and it's permissionless participation. You simply just connect and you use it.
Okay.
So that's Uniswap. Liquidity pools are one of the ways that you can participate. The liquidity pools themselves facilitate this automated market maker model. Mm-hmm. So the trading works because liquidity is provided in these pools. It's provided by individuals, institutions, you name it.
My question is like,
yeah, anyone can participate.
Okay, so is there a single wallet for the institution as well, or do you think that that's kind of dispersed?
It's the same for everybody. Now, you might have infrastructure that has varying degrees of security that's internal to that firm and its own risk controls.
Sure.
But the way that you participate is the same. At the end of the day, that big hedge fund has a wallet, and you have a wallet, and you're interacting in the same exact way.
Got it. Okay.
Now, what kind of security surrounds that wallet and what services support it might be different than what piece of software you use, but you're interacting in the same way.
Got it. Okay.
So where are we? So liquidity pools and liquidity providers facilitate this whole process. To do this, to facilitate the process, you deposit a pair of tokens into the pool. I'll show you this and it'll make more sense in a second when we look at Uniswap. But if I want to provide liquidity for people to trade Ethereum against US dollars, so just ETH priced in dollars, I've got to have some Ethereum, I've got to have some US dollars. I bring both to the table, put them in the pool. That facilitates the trading process.
Okay.
When people use the exchange, they're either buying or selling one of those tokens. So if people want to buy ETH, what's actually happening is that they're selling USD and they're buying ETH, or in this case, USDC, the stable coin. So that pool is going to reflect that for every trade. There's going to be more or less of each one of those tokens coming into the pool. It's called a constant product model, which is going to be used to calculate the price. But at the end of the day, the output is a price of the token based on how much of each one is in the pool, or a price for the pair. In this case, what's the price of Ethereum?
Sure.
So in the pool, if there's less Ethereum because people are buying it and they're putting dollars in, they're selling dollars, the price of Ethereum in dollar terms should go up.
Right.
If it doesn't, well, then that might present an arbitrage opportunity that you could take advantage of. Because over here, you can buy something that's cheap relative to where the rest of the market might be.
Okay.
I know that's a lot, but we'll make it real in a second when we take a look at the protocol. The thing that's important about this in providing liquidity is that when you're using this platform, Uniswap, to trade, I want to buy ETH, I've got stable coins. You're going to pay a small fee, 5 basis points in this case. When you trade at tastytrade or any other brokerage firm, maybe you pay a commission, there are some associated fees.
Sure.
The difference here is that those fees go to the people providing liquidity.
Okay.
Those fees are charged on the notional value of the transaction. Those fees do not go to a company. They don't go to a brokerage. Go to you, the user. In a way, you can run your own brokerage on a blockchain 24/7, collecting a portion of a fee that's charged on the notional value of the transaction. And when things are humming, like they have been over the last month or so, and this month's been pretty good as well, there's a lot of capital that flows through this. And if you're providing liquidity to facilitate the trading, you're making a lot of money.
Yeah.
Like we're talking about annualized rates that are at times, and you just look at the 24-hour period and you can annualize it. So it's not perfect. It's going to be wildly variable. But well over 50%, in some cases well over 100%.
Is there a minimum amount that you would say you would need in order to start participating?
Used to be that you would need a lot more money because the gas fees were so high on Ethereum. When I started doing this, you really only could do it on ETH. And you would pay $60, $100 in gas just to put your pool on. If you wanted to rebalance it, do something with it, interact with the network whatsoever, might cost you another $25, $50. So you had to have enough capital and you had to have a return that generated something, well in excess of the cost to put it on.
To offset it, okay.
Nowadays with layer ones, to set some of these pools up, it might be a couple of pennies. So $500, $1,000, I think is a pretty good starting point. So a minimal amount of capital on a layer 2 like Base, Polygon. You could do some similar things on Solana, but we're talking about Ethereum here today. So we're probably going to run out of time, Katie, but I'll try to get through a bit more of this and show you the protocol and interacting with Uniswap. But how do you participate? We're going to take a look at that in just a second. 1, get some crypto in your wallet, connect your wallet, So get a wallet, get some crypto, get on chain. Once you're on the Uniswap protocol, you select your token pairs, you set up your pool. I mean, it's pretty straightforward. I'll show you the interface in a second. And then once you do that, you're in.
Yeah.
Generating fees, you can make some changes to your pool, but why don't we just look at it instead of talk about it? Because you can do this in the Tasty Crypto wallet. We've got the DeFi dashboard now. You can do this with the browser extension. You can connect to Uniswap with a browser extension. So just very quickly, and then I want to jump to the browser because I do have Uniswap pulled up there. But here is the current version of the Tasty Crypto wallet. Here's our DeFi tab. Click on Uniswap, and that'll take you to the protocol. You can connect the wallet. We're working on this automatically connecting.
Oh, sure.
But you still have to go through that step and connect the wallet. But you can do that in the upper right corner there.
Either with like your phrases.
Oh, no, this is just a pop-up and you hit another button.
Oh, beautiful.
It's just signing a transaction and basically logging in. You can think of it that way.
Okay.
What we'd like to do to make it easier for people is just push the button and you're automatically logged in.
Yeah.
You can see on here a few other ways that you can interact with DeFi. So a lot of exchanges, Aerodrome, PancakeSwap, Radium, and Jupiter. Those are on Solana. So you want to trade some of these memes and other things that we've been trading. You will go there. OpenSea, you can buy NFTs, that sort of thing. But Uniswap is what we're talking about today. That said, let's jump into the browser, and I want to show you the other side of this, the liquidity pool side, because if you recall, we were looking at swapping through this interface last time. The wallet is connected here, so you can see we've got a little bit of capital in here. Probably can turn this into dark or light mode, maybe a little bit easier to see if we turn it into the dark mode. So our wallet's connected. Straightforward process though. You just click the connect button and then click wallet connect if you're using Tasty Crypto. You can find the Tasty Crypto app on there, or if you use something like MetaMask, whatever, some of those bigger ones pop up first. But point being, connect your wallet. Once your wallet's connected, the app is able to read what's in that wallet. So it knows, how much of each one of these tokens we have. You can see we've got a couple different chains in here, a couple different tokens. That said, this is the trading interface where we can swap ETH for USDC and any other token that we want. What we want to do next, or instead, is go to pool. So here you can see all of the pools. We've got wrapped Bitcoin versus Ethereum. So this is Bitcoin, Ethereum on Ethereum. USDC, Ethereum. Ethereum, USDT. Another stablecoin, US dollar Tether. So you can see that these pools here are listed by TVL. This is total value locked. You can think about that as the amount of capital in the pool.
Okay, that's what I was going to ask.
Here is the extrapolated or estimated annualized percentage return, and then here's the one-day volume. My advice, if you're just getting started, is to probably go into something that's a dollar base, because now you only have to deal with the volatility of one token. If I'm trading a pair like Bitcoin and ETH, I've got to be aware of both their notional value, the volatility. They are correlated, but does that correlation ever break down? Sure. So if you just trade ETH versus dollars, or you provide liquidity that way, it's a little bit easier to get started, and you remove the volatility from one side.
Sure. It's like trading, kind of like a micro currency future or something along those lines, as opposed to a cross, right? Where you're like, Euro sterling or Aussie Canada. So I get like not wanting to overcomplicate it right away.
Yes.
Okay.
Yeah, I would stick with this, and I would go into something that's got a decent amount of both TVL and also volume. And so you can see here that TVL is 143, but volume is almost 4 times that. So this is turning over quite a bit, which means that a lot of trading activity, a lot of fees. In the last 24 hours, this pool of $143.9 million generated almost $250,000 in fees. Decent.
Yeah.
Decent return. You can see the makeup of the pool and some other details, and you can just watch as the transactions go through here. So you can see that there's a lot of trading activity that occurs on here. It's not anywhere near what you see in traditional markets, but it's growing, and there's trades that occur frequently enough that you can generate some yield. So all that said, Katie, I want to now set up a pool, or kind of just walk you through how you think about it. Very easy to do that. Here we can see some details about the different pools and then what chains they're on. Here we can create a new position. So when you create a new position, the first thing that you have to do is select the token pair.
Okay. Which two you're going to be entering into the pool.
Exactly.
Got it.
In this case, I want to do this on Base because it's a lot cheaper. So I need both Ethereum and USDC on Base, which we have a little bit for this example, like $40, $30, somewhere around there. But just make sure that you select the token and then it's also on the right chain. So you can see there's...
You know that that's on Base because of the small little icon in the lower right of it.
Yeah, you have to know that this is the Base icon, I suppose, but this is the Base icon. This is Ethereum on Ethereum. It is a little confusing that way, and there are a lot of L2s, but you'll see Optimism, Arbitrum, you'll see Polygon. This is Base. This is Coinbase's L2 Base network. And you want to make sure that the token that you're going to put into that pool, I mean, this is the way that you would do it, is also that same network.
Got it.
So for here, it'll tell you the fee or the pool that you want to be in terms of the fee tier. When I first started this, the fee tier was 30 basis points. It's crazy. But that was on Ethereum. That was bigger transactions, lower volumes. What you've seen is that this has shifted over time. It's the lower fee, higher volumes. There's more money being made, even though there's a lower fee tier.
It's like a ticket charge back in the day.
Exactly.
On the trading desk.
Once you do that, and we are going to run out of time, but the next thing that you do, and we'll continue this conversation into the next show, is you just set your range for where you want to provide liquidity. I'll use a 1 standard deviation range for a weekly basis, given whatever the implied vol and the spot price is. You can provide liquidity across the entire thing, but if you concentrate your liquidity, it's a more efficient use of capital in that for the range, you're going to be providing liquidity only there versus the whole thing wherever it trades. So you're going to get more fees, if that makes sense.
Sure.
So once you do that, you click continue, and you then just simply pick how much of the balance of each token that you have you want to allocate to this. If you were to click the max and you have the appropriate amount of both ETH and dollars, you would just then click review. That'll ask you to sign your transaction. You create your pool. And I don't have one loaded up here, but next time I'll show you a couple live pools. It looks a little bit like a strangle in that you want the price to stay above the low end of the range and below the high end of the range. And as it trades around there, you just generate fees. Then you can collect your fees or shut down your pool. But this is a way to put your capital to work. Yeah. You are effectively constantly trading ETH for dollars at different prices around this curve, but you're receiving a fee for doing that. And so if you're bullish ETH, and you put this pool on, this looks a lot like a covered call because you limit your upside. When it goes out of range to the upside, you've basically sold all your ETH, so you just have dollars.
Yeah.
So you're out of range, but you've generated that return off of not only the price appreciation of ETH as it's gone higher in the range, but also the fees that you generate as it just chops around and trades going up there. It's not a straight line necessarily. A lot like a covered call. You have a yield in terms of the premium from selling the call option. You cap your upside. You are bullish. You do want it to go up to that short call strike. But here, you're participating more like a market maker and constantly generating fees as it goes both up and down and chops around versus a static premium received for selling the call option.
Okay. Yeah. This is super fascinating to me. One really quick question. So if you were to flip-flop those and do USDC on top in this example, and then ETH on the bottom, that is a different pool?
Nope, same thing.
Okay.
Yeah, you can look at it and set it up that way too. So I could set the price range up as USDC or ETH, just depending on how I want to look at it.
Okay.
To me, it's easier to see it priced in dollars.
Yes.
But yeah, it's the same thing. So the ETH USDC is the pair. You might have people that are buying ETH, selling dollars, or vice versa, buying dollars and selling ETH.
Got it. Okay.
So selling ETH for dollars.
Right. You're just there on the dance floor.
You're the market maker.
Yeah.
The market maker is the algorithm, but you're providing liquidity for the algorithm to make markets. And the algorithm, people can read the white paper. They can learn a bit more about how this works. There's a lot of similar mechanisms across decentralized exchanges. But the fact that you, as an individual participant, can allocate risk capital to facilitate the market-making process and then generate fees as a result, I think is pretty interesting and real use case here of DeFi.
Ryan, I'm very, very excited for what is to come as we close out, where do I start? My learning journey is not over.
Yeah, we're going to naturally keep this going, and we'll be back on Monday the 30th. But I think we're going to start to trade a bit more, actually do some of these things that we've talked about, put our money to work, talk markets a bit, and I'm sure there will be almost this educational component to it, even though it's not where do I start.
Yeah.
You'll have a lot of great questions. Hopefully I'll be able to answer some of them, and we'll go forward.
I'm sure you will. All right. Well, if I don't talk to you, have a lovely, time off.
Thank you.
Away.
You too.
You deserve it. And hopefully
You
we see
too.
a little rebound this afternoon and into tomorrow.
All right, fingers crossed. That's going to do it for our show. We'll be back in another week or so. Until then, I'm Ryan.
I'm Katie.
Peace.
Peace.
How much does it cost you guys to do simultaneous hair flips?
Years of practice.
Everybody wanna be like me, yeah. Get up to $4,000 when you open and fund a new account with tastytrade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new tastytrade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? Tastytrade. Make your move.
We are ready to build. This is make or break for this team.
It's down to the last 2 minutes, and it's time to rock and roll, baby.
That's all I got is 2 minutes, and that's on a good night.
I don't know if they're going to be able to make it, but I think they can just slip right on by and maybe take it through to overtime.
I think we're going to overtime. Here it comes.
Man, he hit the boards hard on that. Wait, this is football, right? Woof! Woof!
Take one. Hey, baby. I like the looks.
Got the need for speed? No problem. On tastytrade, adjusting your option positions is a right click away. Rolling just got quicker. tastytrade, make your move.
Calling all traders. Are you using tastylive mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, tastylive has shared the most inspiring stories of traders teaching themselves a new skill, using probabilities and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you'd like a chance to share your trading journey and inspire others.
Oh, yeah, it is Monday, December 23rd, a little bit after 5 p.m. Central Time, the best time. You know what that means. It's time for Tasty Live's evening show, a little podcast called The Price of Truth, a show where we like to explore the incentives that govern our world. And, man, are there some incentives? governing our world today. Shout out to everybody watching on tastylive.com. Shout out to everybody watching on Tasty Trade desktop and mobile applications. But if you want to be somewhere over here, there's only one place to do it, and that's on the evil, soon to be reformed Google YouTubes. Speaking of YouTube, we should say what's up to everybody that's already in the chat. Shout out to my good friends Donna, Ski. I shouldn't say good friends. Who knows? Maybe you don't think of me as your good friend. I think of you as mine. Donna Ski, Sleepy Mocha, Cato Prime, Brian Watson. I'm going to mess this up. Takwetsu Sai. I'm sorry. I'm not good. I ain't had much learning. Katan, what's up? Dav, what's going on? So many more. Do me a favor, everybody. Just keep the chat rocking. It'll spoof the Google algorithm into tricking or getting as many people in here as possible. We can save the world one view at a time. Nice one, Victor. I try, my good friends. What a week last week. And we start this week to the upside. Not a ton of huge volume over the last, today, but the S&P 500, my baby's up 0.75%. The NASDAQ up 1%. The ever outperformer. Thank you, Katan, for those random ass characters. Donna says, I think of you as an online trading friend. Okay. I get the degree of separation. Hold on, Victor. I wouldn't say a friend. I would say you're an online friend. You just online friend zone me, Donna. I'm cool with that. Dow Jones, Grandpa's favorite index, up about 1/5%. And the Russell, the little engine that could, down about 1/5 of 1%. What a week last week. I have this feeling, though, and I asked Ilya this question. Do you think what we saw on Wednesday was a reason to believe the narrative had just changed, or do you think it's an expiration week and funny things happen on expiration week? I don't know if the complexity, I don't want to say it's not the complexity. I don't know if the texture of the market necessarily changed the middle of next week. We shall see. This is another goofy week where it's hard to get a feel on the market. Why? Because it's sort of a shortened, funky, low volume holiday week. And in low volume, any move can get exaggerated. But nonetheless, my babies, we are above 6,000, right around 60.50, which if you watched last call yesterday, Tom gave you his playbook. He said as the market got anywhere close to the highs on Friday, he'd start to lean against them. And they got there towards the end of the day. They didn't give them up. They drifted ever so slightly towards the highs. So not a ton of two-way action, maybe around from 1 to 2. The market gave a little bit back. But from 2 until 3, that last hour trade, they got bulled up again and traded towards their highs. NASDAQ at 21.7. The Dow Jones at 43.3 after, what was that, like 11-day slide, something like that in the Dow Jones. If you can't make the papers by people buying up the index, I suppose you could make the papers by being weak. And we had just a nasty slide, sort of marked by that Wednesday slide down to 42 and change. Guilt by association, Donna. Skew pops, but 2 tasty rotations. Katan, you're probably using some literary effects there, but I don't understand what you're trying to say. I thought we would have a little Santa rally today, but no, it's almost catatonic trading, a little up, a little down. Yeah, I think so. But I think the interesting thing about today is the continuation of the puncture of volatility. The last time I seen you guys and ladies, you people, what do you mean you people? The last time I had seen all of you, we were looking at a VIX in backwardation ever so slightly on Thursday. And if there's one thing that the market has taught me, and we talked about it a little bit on Thursday, it's that if you're looking for opportunities for short-term risk taking, I don't want to say it like that. Backwardation in the VIX is statistically a decent area to try to pull that off. Can backwardations last longer than 1 day or 2 days? Yes, they can. And we made that point, I think, last Thursday, great financial crisis. I think we're in backwardation for something like 150 days, something. It doesn't have to mean revert instantly, but that is probably the exception rather than the rule. And 2 trading days later, 2.5 if you want to count Sunday, but 2 trading days later, you now have sort of a normal VIX term structure. That front end, both cash and front end futures, we've gone from, I think, at some point we were at 27. We were at 27, front end of the VIX curve was higher than sort of the back end, and you had full backwardation. We would go from 27 to basically collapsing down to 21-ish, and now at 17. So a continuation. And I would say probably this is probably an area where you probably look for that to settle out. Why? Because your 17, 18 handle, that's your long-term average, long-term normal in VIX and volatility. That 13, 14, that's probably, I don't want to say it's abnormal. I shouldn't say that's abnormal, but I would say things are going swell. And if you notice, we didn't last too long in that 13 handle until we got a pop, and we got a significant pop. So what did we see when VIX was at the 13 handle? What do we say? The distribution curve, you start to get a right-leaning distribution curve. What does that mean? More overall sessions in absolute numbers, more absolute sessions of leaning, higher, grinding higher, but what do you get? You get an accompanying fat left tail. What that means is you're probably going to get more instances where the market just grinds higher. However, statistically speaking, to move your expected value to keep it even, because you have a right-leaning distribution curve, you get a fatter left tail to sort of even out that expected value. So that the pot, this is what Tom says, the pot odds favor the downside move. That's what he's saying. And what did you get last Thursday? You got that nice sort of 3-4% move, depending on which major you're talking about. The Russell's been weak for a couple of weeks now. Shout out to Elias Spivak, but generally speaking, you get this violent 3-4% day, and it takes a couple of days to normalize that out. But that pot odds discussion, when you got upside moves, you're getting moves from like 0.25%, 0.5%, 1%, and when you get your downside move, it's a 4% day. That's that pot odds discussion. I might say it in a slightly fancier way, with a right-leaning distribution curve with a fatter left tail. It's all the same thing. I'm a visual person, so it's not really a fancier way to say it. I'm just explaining the image I see in my head. And others, they're talking poker talk, statistical talk. They're talking statistics. But you did see the payoff. Whether you got the follow through, that was the big question. And I would say emphatically the answer has been no. No, you have not. And our good friend Chris Vecchio has been sending me all these statistics. I think he misses the microphone. I'm telling you, that guy can't take a day off. But he was sending me, I think, something to the extent of all of the times where breadth goes from a large amount of breadth to a small amount of breadth. A small amount of breadth to a wide amount of breadth. So that's basically what we saw Thursday, Friday of last week. You basically had the technology sector leading the market higher, tech's leading the market higher. Breadth is absolutely garbage by the middle of that week, and that rally, that explosive rally we got on Friday, that was everything. Everything participated to the upside too. You had sort of a lot of breadth all at once. He sent me this fancy chart with all these fancy sayings on it. I go, That's one of the fanciest ways to say buy the dip I've ever seen. We had a good chuckle at that. Shout out to Chris Vecchio wherever he is enjoying this vacation. Sector money flows today. Technology led the way. Healthcare up 1%. That's interesting to me because we've been talking about just how on their butt healthcare it has been. And it kind of doesn't matter which name you pull out. It hasn't been an individual name story. Let me pull up. Let me zoom out here so you can see. Pfizer was on its butt. We started talking about getting long. I'm a little long Pfizer, which makes me sick to say, but I am. Moderna is on its butt. Eli Lilly had a little bit of a discount, not as much, not as pronounced as some of the others. Even if I look at just XLV, the sector ETF, you can see it's come off those highs of nearly, I want to say, 31.5, all the way down to 20. There we go. Try this. Sorry, I had the wrong symbol up there. It's come. I was thinking, I thought that doesn't make sense. 160 down to 140 in XLV, excuse me. But not just these, it's the insurers too. And I know that's not necessarily healthcare. Technically, these are financials, the healthcare companies. The insurance companies. Down from 630 all the way down to 500. There's some extenuating circumstances here, but a lot of these instruments have taken a haircut, right? So maybe the market is priced in the discount to future cash flows with a new administration, perhaps changing in low-hanging fruit regulation. The market's already seemingly pricing this stuff in. Why do I say that? Because I think it's important we all realize United Healthcare didn't just peel off from 630 to 500 for no reason. Right? Is there a change of leadership? Is there a negative headline? A bit, sure, but that's not enough to really change the price of your stock. What the market is anticipating is a shift in the underlying either business or business conditions. So in 3 months or 6 months, when you see some new legislation passed, when the new administration gets sworn in, don't be surprised if you're seeing these stocks do the opposite of what you would think. Because right now, before you get the headline, before you get the new legislation, before you get the more difficult business environment for some of these stocks to operate in, the market already priced it. So now when you get the headlines that drop and they'll start to say the negative things, the market will have already priced it. Watch. Can difficult conditions get worse? Yes. If they start passing things or creating conditions that the market had not forecast, sure, you can see negative reactions. I'm just saying the market on Pfizer didn't go from 30 to 24 for no reason. And currently, the only thing that happened is an election. There was no headline. There was no changing business condition. There was no new legislation that's been passed. So the market's doing its best to forecast a change in the future cash flows, putting it out there. And it's hard for me. You know what I mean? There's a part of me that goes, I don't want to be a part of the swamp. I don't want to be a part of the messiness. There's a part of me that believes Pfizer and Moderna, they've got some explaining to do. Then there's another part of me that goes, look, I got to provide for my kids' college. You know what I mean? I gotta leave something behind when my heart stops working for the kids. And if that alpha exists in a healthcare company, if that alpha exists in a, I don't know, shameless to say, like a prison company, if it exists, somebody else is going to take it. And so is a weird part of me that just goes, look for the discounts, look for value where you see it and play it, because the market doesn't care about my investment or not. That opportunity is going to come and go whether I'm a part of it or not. Gosh, the conflicts in this business, I swear. It's tough. Am I the only one? Are you guys going to leave me out here and say I'm the only one that has difficulty making these types of decisions, that knows that I'm participating in a system that I want to be better? But if I throw a few investment dollars at a leadership team or a business model that leaves me conflicted and makes me somehow part of those negative outcomes, am I the only one conflicted by this? Okay. If you're not conflicted, you're probably not thinking deeply enough about this stuff. Like sometimes I look at some of these therapeutics, right? These therapeutic companies that do a lot of, like, let's say plasma donations, right? Plasma's great. It helps save people's lives. It is a good thing, net. Then I went down the rabbit hole one day and I researched the plasma industry. Not great. 75% of the world's plasma comes from the United States. In other words, we are exporting the world's plasma. There's only 2 countries in the world who allow for the payment of donations. I think we allow a donation once every 2 weeks, and we've never done any long-term studies on what frequent plasma donations actually do to the body. Why not? It's tens of millions of people who are making ends meet in an inflationary world by donating plasma. We don't want to know if this has long-term deleterious health effects to those individuals. Shouldn't we have done that by now? I think so. I think by weight, something like that, we export more blood than plasma in the United States. We have the world's most lenient plasma donation legislation, which ultimately is why we allow the payment for the donation, which is ultimately why we supply the world's plasma. Anyways, I don't know. I go down the rabbit hole with this stuff. And then if you go far enough and deep enough, you'll find the conflict. That's what I've realized. Go far enough, go deep enough, you'll find where capitalism and humanism intersect. And somebody's made a choice. Anyways, sorry. By the way, it's my morning. So at least for you, this is 5:30 at night. Imagine waking up at 7 in the morning and this is how you see the world. Energy up 0.2%. Finally, we got one on the board. Let me see what you guys are saying. Texas Redman says, my morals and politics. It's a good book. I don't know if it's a good book, but whenever I'm starting to feel like I'm starting to question capitalism, I read what the Theory of Moral Sentiments. I think that's the book by Adam Smith. He talks specifically about the morality. It's pretty good. Pretty good. Let's see what else you guys are saying. Mess with my portfolio on a semi-regular basis. Catan says, I'm sticking with LP1 stocks. What could go wrong? Here, I'll tell you what could go wrong, Catan. The new administration decides to take a more cautious stance towards Medicare funding these LP1s, and also decides to mandate long-term health studies somehow, some way. It could, in theory, that could happen. For me, supporting my family takes precedence over other considerations. Yeah, Donna, I know. What you're just saying is you're a rational, self-interested actor in an economic system. But here's the problem. Now look at the prisoner's dilemma. So flip it. In capitalism, we all act in rational, self-interested ways. But in game theory, technically, the way to get the best outcome, if we look at prisoner's dilemma, is for us, in some ways, to not only, it's like Nash's theory of equilibrium, not only to consider our own rational self-interest, but to also consider the best interest of the group. That's the little thing that they never really talk about. Let's see here. Just get the papers, get the papers. Oh my gosh. You like how I did the accent too, Paul? I knew where you were getting that from. Andrew Juarez says, no, Victor, we don't care because you're a nicer person than most people. No, that's not true. I don't think so. I think all people are inherently good. No humans are born bad. You can socialize a good person into bad choices. But eventually, the sinner in us emerges. Catan says moral and politics too. Two messy words for traders. I agree too. You can't trade politics, or shouldn't. You got to be careful. Ralph, you're not the only one. I understand maybe 3% of what Victor talks about, but I'm here to learn so slowly. I don't know if that's a good thing. They say if you can't explain it to an 8-year-old, you don't really know it yourself. So if you're coming here every day and you're only picking up 3%, I think it says more about me than you, my friend. My bad, Sleepy Mocha. I'll do better. What are the LP1 stocks? What's that? Nova. I'm blanking on them. See. There you go. Throw some up for you. So Nova Nordisk, I think Eli Lilly, technically. I think Novo is probably one of the most direct ways, but Eli Lilly, Pfizer, and Amgen are some other indirect ways. And when I say indirect, what I'm saying is it's not 100% exposure. But NVO is probably the closest with the highest amount of direct exposure. They took a chunk out on Wednesday and Thursday. I didn't see that. This one would have been a decent short put candidate. The IV rank has collapsed though, so you can't do any. Hard to sell premium now with only 30% implied volatility and an IV rank at 17. But it is cheap on an absolute basis relative to itself, not talking valuation. Novo at 88.87 and it's been as high as 150. If you're curious, I'll tweet it out. I'll tweet it out later after the show if you want to follow me at Victor Jones. The Owen Jones is 0 because I like to be difficult. But the Congressional Budget Office, the CBO, don't ask me why. I check the CBO website, I'd say once a month for the reports that they do. Because a lot of the stuff that they do is interesting and they never announce it. Like not a few months ago, they basically did a couple of reports of ways to resolve the deficit in the budget, not necessarily to pay down the $36, $37, $38 trillion, but to close the $2 trillion deficit that we run annually. So that if they separated the report into two parts, big ticket items and small items. That was an interesting one. The other one was the impact of LP1 drugs and the potential cost and net savings of effectively subsidizing GLP-1s for the public through Medicaid, Medicare. I'll retweet that one out. To me, that one's worth going through because it's like I don't have the researchers to go through and try to make the estimates, but I think it's interesting at least to see where the government is in making their estimates on what will save, what will it contribute to GDP, what the increase in growth is, and what the cost is. The net cost was, I think, another $400-500 billion to the deficit. So it is a net it's a net negative. With some positive externalities, but it costs. But anyways, I'll tweet that stuff out. It's worth taking a look at. Hims seems to be taking a share from big GLP-1 stocks, but here's the problem. I liked Hims. I like this stock. There was a few that I really liked in fertility. I like this one as sort of like a fertility or lack of testosterone as testosterone solution. That was my play. But as soon as Amazon came into this business, and that was right around here, this big discount was Jeff Bezos announcing that he wants to sell hair and I was going to say a pretty crass word, hair and erectile dysfunction pills. The stock has since recovered. It ended up being a nice little discount to buy into. I'm still long Hims, and they are, if I'm not mistaken, to your point, starting to work down that path. I'm always curious, why is it like, what is it about hair, and I actually know the answer to this, hair and erectile dysfunction that's linked? But I guess I know the answer to that. Let's keep going here. Brian Watson says balanced budget. Think it's going to happen? Let me ask you, Brian, and the chat, let me ask you this question. Do you think we're going to see a balanced budget in the next 4 years? And I'm going to say a balanced budget is if we even get close. So let's say I'm going to give them a fudge factor of $400 million. I'm going to give them a fudge factor of $250 billion. Do you think we balance the budget in the next 4 years? Yes or no? Big trucks, Victor. In the next 4 years, do you think we balance the budget? I'll wait for your answers in the chat. I'll move on, and then I'll come back to this topic. Next 4 years, do we balance the budget? And balancing means come within $250 billion. That's all we have to do. We are currently running a deficit just shy of $2 trillion. All right, let's keep cruising. Before I talk specifically about bonds and notes, let's go ahead and take a quick look at the yield curve. Take a quick look at the yield curve here, and you can see what continues to happen. I thought that's probably a dangerous word, dangerous phrase. But what we've seen here, the red line is the first cut in September. I remind you every time, but it's just in case there's a first-time viewer. What I like to do is look at the yield curve at different points in time. The yield curve, the yellow or the red line represents the yield curve, or where yields were along the tenors, along short-term rates and long-term rates, where they were at the time of the first cut. The first cut came around September. I think it was September 18th. Somewhere where we started a 50 base point cut. The green line is the second cut in November. The blue line is the third cut, December, just last week, which we've now memorialized with a static blue line at December 18th. And the yellow line, which we've now added, is the yield curve as of today. And you can see as they've dropped short-term rates are over here. As they've dropped those short-term rates from 5% to 4.75 to 4.5 to now 4.25, as they've dropped those short-term rates, the long end is lifting. And not only is the long end lifting, but what's happening as the long end is lifting, the Federal Reserve is also communicating higher levels of inflation expectations. So think of it like this. Why would the long end lift as they're cutting rates? So let's sort of think about the short end is the policy end. So what the short end is doing is monetary policy, because the Federal Reserve actually controls Fed funds rates. So what they do with short end rates, everything sort of in the shorter end is linked to the Fed fund rate. The policy rate goes down. It means that they're they're not necessarily taking care of inflation. They're easing up on their inflation fight. So the higher they keep those short-term rates, the more confidence the long end is going to have that those high interest rates are going to slow growth and inflation in the economy. But as you drop the short end, what you're saying is we're putting less pressure on growth. We're putting less pressure on the economy. And as you do that, you're unlocking the potential for future growth. You're unlocking the potential for future inflation. So as the short end rates drop, the long end is saying, oh, you're putting less pressure on the things that I care about. Because think, what does a long-term bond investor care about? They care about the purchasing power of their investment. So if they put a ton of money in these treasuries that's paying them 4% or 4.5%, and then at the end of 10 years, they're going to get their principal back. A bond investor wants the purchasing power of all the principal that they're going to get back. They want that paid for. Whatever purchasing power has been eroded, they want that paid for in the yield, and then they want some surplus yield on top of that. So the lower you take short-term rates, the less confidence a bond investor in the long end says, I don't know if I'm going to get my purchasing power back, because I think inflation is going to be more of a problem. The lower you take these rates, the more inflation could become a problem. So I want more yield to make sure I get the purchasing power back. And I want an additional premium I want an additional premium each year, each month, because I have a little bit less trust in what you're doing. So I'm going to charge a little bit of a premium given the lack of trust I have in how you're executing monetary policy. So this is sort of the thinking, very simplified thinking of why we're seeing long end rates go higher. That a bond investor has less and less confidence that they're going to get repaid, the purchasing power repaid, along with an effective yield that covers their risk over this next 10 years. And so we're seeing this dance with the long end rates and short end rates as they move, the short end rates lower, long end rates lift. I sort of thought that as we got to the opposite end, as soon as we got to this point in time, which is what I feel is the pause, after the December cut, they are signaling a pause, that they're not going to move in January. And depending on what the inflation data shows from now until March, they could end up pausing in March. They can end up pausing for using inflation as an excuse not to continue to move rates higher, lower. And if they do that, they're going to be doing exactly what the bond market wants them to do, which is not to necessarily lower rates, to put pressure on growth, to put pressure on inflation. And so in theory, I thought that on the flip side of this December cut, we'd actually start to see yields move the other direction. We haven't seen that yet. What is one of the reasons why we perhaps have not seen that? Well, because they gave the bond market a little kiss before they left. So before they closed the door and said, we're going to pause, which would have potentially got the market to buy up bonds and then ease financial conditions and then create animal spirits in the marketplace, they gave the reason a market to hold on, the bond market, a reason for pause. What was the reason? They put what's called a summary of economic projections in front of everybody last week. So not only did they cut rates, which the long-term bond investor doesn't love, again, because lowering rates puts less pressure on growth and inflation, which then erodes your purchasing power, which means maybe you're going to sell bonds because you don't have the level of confidence, or maybe you're going to demand more yield because you don't have the level of confidence that they're doing what they're supposed to do from a bond purchasing power standpoint. So what did they do that slowed the potential for the marketplace to go in and start buying bonds and ease financial conditions? They they put this summary of economic projections in front of everybody, and they said, hey, be afraid of inflation. They said, remember when we told you we were going to be on pace to get to 2% by 2026? Remember when we told you to expect only 2.2% inflation for 2025? We were wrong. And we weren't wrong by a little bit. We weren't wrong by 1/10 of a percentage point. We were wrong. We're moving that to 2.5%. And that's a pretty big, that's off by a ton. Imagine the Federal Reserve is responsible for two things: stable prices and maximum employment. And they just told the marketplace that their projection for prices was wildly off 12 months in the future. They were so far off, and they had to adjust that from 2.2 up to 2.5. That's a big difference. So all of a sudden you're in a situation where if this is 2.2 and growth is 2.1, well, that would mean a bond yield, doing simple back of the napkin calculation, of 4.3%. And yields in the 10-year prior to this announcement was, I think we're like right here, 4.4%. So in my mind, in my thinking, the marketplace was at 4.4%. Their previous SEP had yields being in the ballpark of 4.4%. And so I was thinking maybe they true up 0.1%, maybe even 2%. And if they do, you're probably going to get a rally down to like 4.3%. You get a rally in bonds and yields come back down to 4.3%. Was the way I was kind of thinking about this whole thing. But I didn't really see a world where they were going to push this up 2025 and then move off their 2026 target to get to 2%. I didn't see that world. Probably should have in hindsight, but I didn't. But this is the reason that sort of kept bond investors from coming in and buying, in my personal opinion, because now you're telling people to expect 4.6% at best. And guess where we are right now, my babies? Yield moved its little way up to 4.6%. Now, inflation expectations, the data could substantiate being worried about 2.5% inflation, or the Fed could have pie on their face, and we could have disinflation much faster than people are expecting right now. You know, there's a case to be made where China's currently in deflation. Germany's economy hasn't looked good, let me say. And the global economy has been slow. But if that's turning, there's a case to be made where they have undershot these growth estimates, that this doesn't need to be 2.1%. Remember, the current administration is trying to aim for like 2.5% or 3%. They got 3% growth, add 3% onto 2.5%, and now you're talking yields of 5.5%. That's basically how this works, back of the napkin. And I said this on Thursday. This is a what do you believe market. Do you believe growth and inflation are going to just roar in 2025? Or do you think we're rolling and that the economy is softer than the headlines are articulating, and that we're not going to get close to 2.5% inflation? The risk is going to be the opposite, and growth will be muted. In that world, yields look pretty attractive. But I think given the unknowns, 4.6 probably early. Maybe get to 5 before that becomes an interesting risk reward. Because if you think your worst pain as a bond investor is 5.5%, you're somewhere between the yield should be somewhere between 4.6 and 5.5. You probably start to take your bet with high confidence at 5%, your midpoint. So maybe I'm a little early. At 4.6%, maybe I'm a little early. But I'm risk defined and it's small, so I can stomach it. Let's see what these guys are saying. What did you say about the budget? McNutty says no chance of a balanced budget inside the next 4 years. Brian Watson says 25 delta on a balanced budget happening. I think that's probably good. That's a good number. No chance of a balanced budget. Only if they mint a $2 trillion coin. Smart response. Darren says, hell no. Victoria, thanks for going over this again. Still new. You're all good, Victoria. Cactus Leo, Boomer Bonds. Here's the reason I go over this. One, because I don't think a ton of people on the network talk about bonds. So at some level, it's find your niche and create value across the spectrum of investment opportunities. I don't think I'm the greatest at speaking about bonds, but I think giving people some reason, some fundamental aspect of thinking about yields, it helped me. Maybe it'll help some. Because to me, yields are anything but technical. I could care less. There are a lot of markets where I care about technical analysis. Yields and the bond market are not one at all. So anyways, that's part of it. And then two, I just think, to me, all of risk taking is behind the yield. In other words, the yield is first. And if you understand the yield and the volatility around the yield, to me, then you can start pricing risk further on down the curve. But if you don't have a decent handle on the risk around the interest rate, well, that's the core of your risk curve. That's the very beginning. And everything follows that behind. I can tell my daughter just woke up. Sorry for the crying in the background. I gotta soundproof this room one day. So Shab says, LOL, is the long-term bond a good buy at this price? So safe side, wait for 10-year, then buy ZB1. Safe side, wait for 5%. So here's the cleanest way to say what I just said, Shab. The safe side would be to buy yields above 5%, somewhere between 5.25% and 5.5%. That would be quote unquote safe. We might not ever get there, but if you're trying to be safe and avoid risk, given the current projections of the economy and inflation, the safe side would be buying yields somewhere between 5.25% and 5.5%. The more moderate risk and reward, and if you can get it, you probably got a decent price. But the question is if we ever get there. A more moderate area to buy, what you probably have 1 unit of risk to 1 unit of reward, is probably buying bonds at 5% yield. I am crazy, and I already have a position. It's small, so I'm going to ride it out. I'm okay owning ZB at 4.6%. But I acknowledge I'm probably early. So Shab, if I didn't have a position, if I was coming into this with fresh eyes after just getting a look at the SEP, that's the way I would answer your question. I think this previous low in the structure of the market at 112.5, or I should say 112 to 113. To me, I'm sort of playing the idea that the market may buy yields at this range on a short-term basis, but I'm okay taking pain. So, but your question was, where's the quote-unquote safe? Nothing's safe because none of us know the future, but given the information we have today, it would probably be between 5.25% and 5%. My moderate bet's at 5%, and an early aggressive bet is somewhere now at 4.6%. And it's aggressive, but the idea is we have had buyers at yields at 4.6 to 4.7% in the past. We'll see if it happens again. No problem, Shab. It's a good question. I I realize sometimes I can be the either or, the two. It's like the joke of the two-handed economist. This could happen or this could happen. The truth is, Shab, I don't know what happens in the future. I just construct ranges where I think I've got decent bets and go, do I want to be aggressive, moderate, or conservative in my bets? And then I just hope I've carved out the right ranges. Let's see here. The volatility of bonds is crazy right now. Not sure why you invest in them. Tradable. Now, I would say that's true. So Joe says the volatility in bonds is crazy, or excuse me, McNutty says the vol in bonds is crazy right now. Not sure why you would invest in them. Tradable now. I would agree with that statement. I would tend to agree with that statement. But I also think yields are sort of a F around and find out. We're clearly searching, we're plumbing for higher yields on purpose. And we're trying to do that slowly and methodically. And the idea is the slower and more methodical you get there, the more opportunity that participants in the economy have to adjust to those higher yields. And you're probably going to pick off, the companies that have really high levels of debt, really poor business prospects in the future. They're likely going to shutter their doors. They're going to sell their assets. But you don't want all of that creative destruction in the economy happening all at once. So you kind of we float along making higher yields, but very, very slowly. And if you're able to do that, the unemployment rate ticks up slowly. Zombie companies start disappearing slowly. Consolidation happens to the bigger corporations that have cash to buy up those decent assets or competitors or M&A activity slowly. So in time, you see a consolidation of actors in the economy, hopefully low volatility and unemployment. I mean, that's what this whole thing looks like, right? That's how you get to a higher yield, slow growth, and you try not to crush the economy at the same time. It's a slow, methodical process. Seems like that's what we're doing. And so to your point, why would you invest in bonds? I don't know. I don't know that I would, because I see over time the very real potential of higher U.S. yields unless we clean house internally, right? Unless we give a bond investor more reason to want to buy yields at 4.6%, because we are going to be fiscally responsible, and the purchasing power of those bonds are going to require less yield to be confident that you're going to get it back. Until we provide that to the bond investor, then likely what happens, assuming they continue this managed destruction, the likely path is going to be higher yields. Because you don't have central banks buying this stuff anymore. You need to find a natural buyer. If you can imagine how much of this paper all central banks were buying forever, and all of that paper still exists, and we now need a private buyer to buy up all that paper. And we're going to find the real yield, the market rate on all of that paper, both in the U.S. and across the globe. So I do think yields over time creep higher, but it's not always about like where I think yields are going in the longer term, right? As a trader, I'm trading a 30 to 45 day cycle, and though I think we'll be at 5% yields at some point in 2025, I don't think we go straight there. So I like to trade the counter trend move. So if I feel the trend is towards higher rates, some people will only trade with that trend. So they'll wait for a bond rally, then they'll sell bonds, betting that yields are going to go higher, bond prices go lower. I'm not that guy. I'll trade the bond. I want to trade the bond rally and the bond fade. But unfortunately, trying to trade the bond rally is hard. The understatement of 2024. I think the good thing is we called that yields are going higher, and we called that it was going to happen on the cut. And we called this rally. I just thought it'd have a little bit more staying power than it did, but it didn't. Let's see, McNutty. Part of the selling has to be the fall expansion in what is supposed to be something else. 2022 was a disaster for bonds. I would agree with that, McNutty. You know, the larger the range in the wider the distribution curve of the potential outcomes of rates, that reverberates through everything. Let's take a look real quick. I love going to this FedWatch tool. Most people just, if you just Google this, just Google CME FedWatch tool, something like this, and this is the tool that comes up. It's delayed, I think, by 15 minutes, but it's free, and I think it's decent enough. I don't think you really need the real-time probabilities. And if you do, you have one of the most interesting trading strategies I've ever come across. But most people stay on this current tab, and they're just basically looking at the probabilities of a cut at each one of the meetings. I really like looking at the aggregated tab because in some way it pulls out the implied curve and makes it much more useful for, I think, the average everyday person, what they're actually looking for, which is not only the probabilities that at the next meeting they don't do anything, right? There's a 94% chance that at the next meeting they're just going to hold rates. And then currently a 54% probability that even in March that they're going to hold. And that the first cut of 2025 isn't going to come until May, is when we're now talking about being at a Fed funds between 4 and 4.25, and then for the rest of the year, the market has them holding it. So literally only one cut priced in to 2025, and that's in May, and then it's holding for the rest of the year. And remember, we were just at 3 cuts 2 weeks ago, folks. Prior to the CPI 2 weeks ago, this was at 3 and a possible. It was a December cut plus 3 and a potential. And the CPI came in warmer, PPI came in super hot. And then the FOMC said, you should expect 2.5% inflation next year. And the market goes, oh. And now you've got people talking about the potential for a hike, which I don't see happening. I think if anything, they hold all year. I don't see a hike happening, but I also think this is probably peak hawkishness. Some part of me wants to say this is peak hawkishness, and I think somebody I follow said the same thing. Fed Guy at Fed Guy 12 is the follow on Twitter. He used to work at the Fed. Joseph Wang is the name. He wrote a book as well. I think it's called Central Banking 101. Great book. If you want to know sort of the inner mechanics of monetary policy and how the banking system works at a very, very high level, explained really well. It's a really good book. It's not too long either, a couple hundred pages. Let's see here. Black Swan event has to be when people don't show up for an auction. Scary stuff I try to forget. Agreed, McNutty, but that's the thing that's the boogeyman that's been there for decades, Andrew Juarez, I've watched a lot of media traders be early over and over with the long bond. It's much more relaxing to just wait for extreme and go bigger in size. I think that's good advice. I think it's good advice. At some level, I'm probably a little bit damned. There are, if I'm being honest about the bias in my job, it's if I came here every day and I just said not doing anything, if I didn't have an idea or I said, I'm just sitting on my hands, that would be a pretty boring show. I'm not saying that I don't believe in the ideas that I do share, but I'm saying I'm probably biased to look for constant opportunities in a way that likely if I didn't have a stream every day, I don't know that bias would be there. I'm just being honest. But there's no part of me that consciously goes, "Oh, I gotta make up a trade idea." I don't do that. Anyways, let's talk for a little bit about some of the big movers for the last. What book was that? I Need Knowledge. I believe it's called Central Banking 101 by Joseph Wang. It's the only book Joseph has written, I believe. I think his handle on Twitter is FedGuy12. I'll type it all in for you. Central Banking 101. It's a good read, in my opinion. Another scorcher of a day for Palantir, up 6% last week, not day. Trading above, broke the highs up to 82. 82.02 today before falling back. A little bit of a doji candle. I'm sorry for bringing in those words, but Palantir's just been a monster this year. I swear I'm gonna sneeze. Palantir was the biggest trade. The biggest trade of 2024 for me was Palantir. I don't know what to do with it now. I think a short call position just got exercised, so I'm gonna have to reestablish. But man, what a monster Palantir's been. I don't know that I would put an incremental dollar here, but I don't know that I would fade it either. Kind of a tough trade. I was a bit surprised by Tesla today, and I'll tell you why. Over the weekend, I don't want to go too political here, but over the weekend, President-elect Donald Trump was speaking to, I think, a gaggle of reporters over that Turning Point conference or something like that. And he was asked about, there's just like this recurring media narrative, which is President Musk, President Musk, President Musk. And in my personal opinion, that's done for an audience of one. Trying to play to Trump's ego. And I think, call me conspiracy theorist, but I think it's purposeful to try to sow division in the alliance of that group. And he responded. He said, President or Elon Musk is not president. I am, something to this extent. And I was like, oh, one, I just thought that was bad politics. Because he sort of talked about something that was silly in a sincere way, and it breathes life into a story that doesn't need life. But then also I was like, I wonder if that's good enough to bring Tesla down a few bucks. Some part of me was thinking that in and of itself, that the president-elect saying, putting separation between himself and Elon was enough for some downside. And I'm glad to know that that's not the case. Tesla up 2% today. Because I think it would have shown how fickle this rally has been. It's based on a relationship and not necessarily anything of substance. I guess for now, the market didn't take it too seriously. And it looks like this rally has a little bit more legs. Is anyone trying to fade Tesla here? Congratulations if you did it last week. But are you think that's over with, or would you still try to fade it here at 430? That's always the tough part of trying to fade Tesla, right? You probably want to fade it at 400, and you're right, but the problem was the price to fade it was 490, and it only pulls back to 430, which means you're still a 30-point loser. That's the tough part of playing both sides of a market. Just a second. I want to sneeze so bad it won't come out. Let's keep cruising here for just a little bit. I'm going to skip over the dollar. I'm going to talk Bitcoin as sort of the implied dollar discussion. If I sneeze here in a second, you're going to know why. But that move off of, it seems like just the weird thing about last week was there was no flight to quality. So like the thing I was asking myself was like, where'd the money go? You know what I mean? Where did the money go? It didn't go to the short end bonds. It didn't, I mean, short end of the curve. It didn't go to the long end of the curve. It didn't go to commodities. It didn't go to value stocks. Didn't go to tech. Bitcoin, gold, silver. Is it like, where did the money go? Is the thing I keep asking myself. I suppose the dollar got a little bit stronger, and that's part of the answer. But it was a very, it's not like it went to like overseas markets. It's not like China rallied or Europe rallied or anything like that. If anything, they actually rug pulled a lot of the international markets too. Here's Europe, disgusting down day candle. Here's China. I mean, China's not going anywhere, I suppose. Let's go Mexico. Brazil. I mean, if I went around the world, you'll see that money came out of all assets globally, and I can't figure out where the hell it went. Help me out. Can anyone tell that? The reason I like to watch money, the reason I'm bringing this up is I like to watch money flows. So every Saturday and Sunday, what I do is I figure out, okay, what was the sector rotation? Was there an international rotation? Money go domestic to international, international, domestic. Bonds, commodities. I look at money flow in the weekend and I'm like, there's this gigantic hole and I can't figure out where the hell everything went. Just went cash, I guess. And how does that make sense? How does the Federal Reserve telling you that inflation is going to be 2.5% next year, and people go cash? How does that make sense? It doesn't. I couldn't figure out the money flow last week. But anyways, Bitcoin down to 94.8. I'm still long a little bit. I told you on anything below 88, I'd have to reconsider. Shab says, the money goes to fart coin, I guess. Oh my gosh. I can't believe this is real. How are we not living in a simulation right now? But anyways, Bitcoin down to 94.8. I said I would stay long until 88. And then I would change my thesis. Yeah, at 88, I'd probably have to reconsider the environment that we're in. But I think at 94.8, I don't think this, so there's some part of me that goes, it would be normal to trade around 100,000. I didn't think we would. I thought we would quickly see 100 and then go to 115, 120 to get the hook, to get people. I thought what would happen is the human psychology would say, we hit 100,000. It goes out in all of people's news feeds and their 5 o'clock news programs. And for whatever reason, the psychology of crowds goes, this instrument hit a big number, I want some. And I thought that would be the catalyst for people to go. They would have FOMO and you get a bunch of new liquidity, moving it from 100 to 115 or higher. I thought that's how human psychology would play itself out. But it didn't. And instead, we're seeing this consolidation around 100,000. So do I think just because we've gone to 94.4 that the trade is over? Not yet. Not yet. I think we've gone 8,000 over. We're 6,000 under. I don't think it's a big deal. I think we could still be trading around 100,000. So I'm staying long. And again, for anyone that's new, we think about Bitcoin on this show in two buckets. One bucket is the stuff you buy and you don't touch. The other bucket is this. We also want to trade around price movement in Bitcoin. We're talking right now about the second bucket. So we were long at 61.5 on a rejection of 100,000 the first time. We got long around 91. I should probably put it here. And we said we would play for something like 115 to 120. And if we had a reversal below 88, that's sort of where it would change my mind, and then I would close out the position. So we're sort of in between. And I think it's very possible we stay range bound around 100. We'll see what happens. Gold at 2630. Still not a bunch. Found legs at 2600. I think some part of me wonders if I should move up the target. I had told you guys I would feel comfortable buying at 25 if they broke 25, especially so in the 24 handle. But it seems like there's buyers at 2600, and they're not really giving us an opportunity to buy gold cheaper than that, which is why I've changed my strategy from buying the underlying to moving towards, I'm going to say it again, you guys can cook me if you want to, but this is why I've started to buy the miners. To me, there's a bigger discount built into the miners. So do I want gold? Yes. Do I want it cheaper? Yes. But if it's not going to get cheaper, either because China or other central banks or just because of market dynamics, well, then that would be good for the miners in theory. If gold's not going to come off 2600, to me, they've taken too much out of the miners. And if it does get down to 24, 25, it seems the miners have already been priced that way. So anyways, I'm going long Newmont. I've added to the position, and then the new one, which Pete brought up this Sunday, which is Freeport McMoran, which is a copper mining company. I think about 70% of the revenue comes from copper, so it's highly correlated to the price of copper. It's now at the 38 level, where we've had some support in the past. Let me show you a longer term chart of this. I just do not understand it. I'll speak to this here in just a second. So a decent area. It's not the cheapest area we could be in, right? That post-COVID dip to 25 would be more interesting, but at 39 you get into some sort of a discount. What I don't understand, tell me how. How do you have inflation expectations moving up and commodities, generally speaking, getting crushed at their lows? How? One of those things, it's likely one of those things is not true. And this is why I'm buying bonds and buying commodities. Because one of these two things is not telling the truth, or both. How do you have inflation if commodities are going down? In that case, you're going to have disinflation. Crude oil's not moving; it's flatlined at 69. Copper's at lows around $4. I guess natty gas is sort of doing natty gas things to the upside. But my point is, a lot of these commodities are moving lower. At the same time, inflation expectations are moving higher. What I'm sort of betting by going long commodities and long bonds is that inflation expectations will come in, and commodity prices will come up. In my opinion, those need to converge at some level. And that's what I'm doing, if you're curious. It's a painful trade because, commodities in the last quarter, it goes from like being the most loved, materials go from being the most loved to the most hated. It's this crazy binary trade. And last quarter, it went from being loved to very quickly being unloved. But I think one of these two things are true. Either commodities are at the lows, they're forecasting low global growth, and that means you need to bring your inflation expectations down, which would mean bonds rally. Or inflation expectations are correct, and these commodities need to come up with growth expectations and those inflation expectations into 2025, or they need to converge. But in one way or another, I'm buying that divergence. That's basically what I'm doing every single day. Money went to donations for the Trump inauguration. Yeah, everybody kissing the ring, donating $1 million to get their sit down, to get their dinner at Mar-a-Lago. It's so weird how they do that stuff right out in the open, isn't it? Here's $1 million. Can you now invite me to have dinner with you so I can say sorry to your face, and don't kill my business, please. That's basically what that whole thing is. All right, everybody. It is Christmas Eve for me. So I want to say we got some preparations to do for the day. But I want to say happy holidays to all of you out there. I'll see you back in a couple of days whenever we come back off the holiday. I want to also thank all of you for this year. It's been a cool ride. I know we're not to the end of the year yet, but I'm feeling the festive and holiday spirit mood. I'm wishing you all the best in 2025 in both your trading, your professional lives, as well as your personal lives, whatever your pursuit, whether it's like health, mental health, family, travel, whatever your thing is for 2025. I wish you a lot of joy, and I hope you're able to accomplish all the goals you set out to accomplish and much, much more. I want to thank you for being here and choosing to be here. You can do a lot of stuff with your time, but you choose to spend it here, and it means a lot to me. From the bottom of my heart, thank you. Happy holidays, everybody. We'll see you back here on the flip side of the holidays. Peace.